All right, welcome everyone. This is the Saturday VIP class. Today we are going to be talking about options, verticals actually, not just options, verticals. And I hear there was another fantastic class that happened this morning. I didn't get to attend it, but hopefully some of you did. But let's talk about options. So this is intended primarily for people who are new to options, or you just need a refresher on options. You just need to know what's happening, what's the deal with options, what are they, and how do you make money from them? More importantly, how do you not lose money from options? So that's where we're going to be. To level set, the expectation is obviously that you have read the curriculum, that you know a thing or two about calls, hopefully more than just a thing or two, and that you have practiced a lot buying calls, buying puts, and now this is your very first time, or maybe not. You're now going to be in the business of selling both calls and puts in combination with actually buying them. So we'll talk about how to construct a vertical. We're going to concentrate a little bit more on credit spreads than on debit spreads, but I will entertain questions on both sides. So bear with me if I defer your questions of a different topic to much later in the in this session. So this session is about 2 hours long. There's a good chance that we're going to be going a little further out than 2 hours. That's okay with me today. So yeah, I love the humor in the chat. So talking about the chat, by the way, if you do send me something directly, I probably won't see it because it just scrolls so fast, and I just don't have the time to scroll up to go look to see what that person said. So if you have a question, place it out to everyone, right? Just send it to everyone, and that way you can get help just in case I do not see it. Today I do have a helper, Latonya. Thanks for helping me out. She is going to pretty much help you guys out with things that I don't see, and also your raised hands. Any questions before we get started? All right, no questions. All right. So the chat of choice today is going to be SPX, all right? SPX, because a lot of people love SPX, and it's been doing pretty well over the last 1 year. SPX has been trending upwards. It is representative of the American economy, which we see to be very strong. We're going to continue protecting that, and we can get some consistent income just trading the SPX. There are people who trade these every day. In fact, they don't trade anything else. So that's a good income builder, and we'll see how to take advantage of that. I like to look at the 6 months, 1 day chart. That's what you're looking at. Hopefully you can all see my screen. And then occasionally we'll go into the 1 week chart, very rarely, but I spend a lot of time on the daily chart as well as on the 15-minute chart. So you're going to see these, I'm going to flip back and forth between those two. So let me talk about first a vertical. What exactly is a vertical? And we'll begin by explaining the simple concept of buying a call. Right? When you buy a call, or actually, let's go back a little further than that. When you anticipate that the underlying is going to increase in value, in price, that is, you buy a call. And sometimes that call could be pretty expensive, so you decide, you know what, I am going to actually sell it, right? And when you sell something, say you sell a put, you're saying that the price of that underlying, when you sell a put, you're saying that the price of the underlying is going to remain above a certain price, right? You sell a put. If you sell a call, you're saying that the price of that underlying is going to remain below a certain price, right? It's kind of awkward, isn't it? You know, we're talking about puts and being bullish and then calls being bearish. It's kind of odd. And that's where the confusion starts, because now you have to have a new way of thinking when you introduce selling calls and puts, right? Selling calls and puts. Buying calls and puts is pretty straightforward. Well, you buy a call, price goes up, you make money. You buy a put, the price of the underlying goes down, you make money. You sell a call, the price of the underlying goes up, you make money or you lose money. You lose money. Yep. That's where the confusion starts, right? It's a call. I should have made money. No. Because your thesis was that the price was going to remain below a particular price. You sell a put, the price goes up, what happens? You make money. Yes. Yep, you make money. And if the price goes down, you lose it. So I'm setting the foundation here for, do we sell, do we buy? And when do we do what? That's important. So let me draw some lines on these ones. The lines are real, but the examples are kind of fake, but they do represent real life. So this is SPX. I'm looking at the daily and I see that this is today's candle, right? Or yesterday's candle. 44.55 is where we kind of ended up. And my thesis says that I am not going to, or price is not going to fall below 4,400. I'm just going to pick an arbitrary figure here. Price is not going to fall below this line over here, 43.94. And so I am going to buy, or I'm going to sell a credit spread, a put credit spread below this, right? I'm going to explain all of this. So I'm going to get a PCS in this area. If my thesis was that the price of SPX was not going to rise above 4,500, right, above 4,500, then I'd sell a call credit spread. I'm just going to put an arbitrary line over there, and this is going to help me explain this concept. It's also going to help explain it to, it's going to open your eyes and your minds for, you know, just in case you haven't heard of spreads before and you're trying to figure out what side you're on. So this is a good way to think about it. A CCS when you think that the price is going to go down, and a PCS when you think that the price is going to go up. Is that about right? Anybody confused about that part?
Yes, could you say that one more time?
Sure, I could do that. And when the price is somewhere above the target or the support area that you have identified, we'll also call this the support area. How about that? Let's introduce some new terms today. Right? Support and resistance. Hopefully that makes sense. Does that make sense? What support and resistance is?
Yes.
So support is always going to be below your current price. Always below your current price. Resistance is always going to be above your current price. If the price of the underlying rises above 45.01, which was your resistance, is that now still resistance, or is it now support?
Support.
It is now support. That is correct. If the price goes below 43.94, which was previously your support, does that remain support?
No.
It is now resistance, right? It is now resistance. So that concept is carried forward from your buying and selling levels. Remember when you were at the buying level or the buy zone, when price fell below the buy zone, now it became a sell zone. If it falls far enough, it is now a sell zone. Same is true if price goes way past your sell zone, that sell zone is now a buy zone. So think in terms of support and resistance as an easy way to identify where is the price, what is the location that I am trying to be at, right? And we'll run through a few examples. We'll run through how to build these credit spreads manually. And the reason I will do that is because of our Canadian friends who do not have Thinkorswim, and they have to do this manually. So they have to go into the single option chain and click way too many things in order to build a vertical spread. But I think it's important for everyone to know how to do that. Thinkorswim and TradeStation and most of the brokerage firms make it easy. Interactive brokers, not so much. All right. Yeah. Thank you. We love you too, Anita. That's the Canadian. She's representing the Canadians. Awesome. So let's I was supposed to be repeating something. Somebody asked me a question. Could you repeat it? I forgot about it. I started talking about other things, please.
I think it was about the support and resistance. You renamed it.
Okay. All right. So yes, support and resistance is essentially relative to where the current price is, right? So current price is in the middle, support is at the bottom, resistance is at the top. Let's talk about momentum, right? Momentum or direction of the market. If the price is going down, right, or market is trending downwards, we do not want to sell or put a credit spread. Why? Because it is coming towards our put credit spread, and so that becomes threatened. We're going to look at the semantics of how to do that so that we understand why is it threatened. Okay, and then if the market momentum is trending upwards, we want to sell a put credit spread, right, and not a call credit spread. So how do we build that? How do we build each of those two things? To get a call credit spread, or to build a call credit spread, we need to sell one leg closer to the current price, and then buy one further away from the current price. So think in terms of when we do credit spreads, the short leg, let me type some things over here. So the short leg is closer to the current price, right? Current price, and the long leg is further away from the current price. Hopefully that is clear. Is that clear? What that means? Is that clear? What that means? What is the short leg and what is the long leg? I've actually had that question asked before. So the short leg means that you're selling, right? You're selling that one, and the long leg means that you're buying. Hopefully somebody understands that or is helped by that statement. The short leg is the one that you are selling. The long leg is the one that you're buying. It doesn't matter whether it's a call or a put. If you're buying it, that's the long leg. If you're selling it, that's the short leg.
Hey, Eddie, somebody needs to mute their speakers.
Yep. That would be, I don't know who it is. Let me find
Eddie,
out.
you might have a little background noise at home, right?
Is it me? Okay.
I don't know. Maybe. I was just thinking maybe the family. So,
Yeah.
You know what? I did have one comment in here about you were explaining the CCS and the PCS, and I know you said you changed the terms. I just want to make sure that everybody's clear on that. The CCS
Okay.
and the PCS, you said you changed the terms to resistance and support. And Samantha was asking for you just to explain that.
Okay. All right. I'll do that.
You're muted. We can't hear you.
You're muted.
Eddie.
Yep. Yep, I was requesting my kids to shut these doors over here so that we get rid of that background noise. All right, cool. All right, so somebody wants to find out why did I rename these to resistance and support? Is that the question?
I think so. I think that's
I'm just identifying where price is relative to current price, where it should. How do I explain that? If I plot this would be my seller zone. The resistance would be my seller zone, and the support would be my buying zone or buyer zone, right? So we'll do some examples, and it will make sense as we get along.
Eddie, could you also you were going to go? You said something about CCS, like when the price is going to go down, and PCS when the price is going to go up. Could you elaborate on that a little bit and what that means to the equation?
Yep. That's what I'm about to do. But you did say it correct. CCS when price is trending downwards, and PCS when price is trending upwards. And as we construct a credit spread over here, you're going to see why that is important. It will become very clear. So right now the price is 44.55 for SPX, and we are estimating that it could go either way, right? It could go up or down. So let's think about where would we buy or where would we sell our credit spread. So walk with me here. Would it be safe to sell something in the 4,500, 4,505 area for a call credit spread with our thesis that price of SPX is going to reduce? Would that work? It would work, right? A lot of yeses. And it would work because we have to think in terms of when do I profit from a call credit spread. I profit from a call credit spread when, or even a put credit spread, when price stays away, right? From price stays away from my spread. So I'm going to say here best case scenario is price moves or stays away from the credit spread, right? That's the best case scenario. Worst case scenario, which has happened to many people, worst case scenario is price moves into and possibly through your spread. That's the worst case scenario, right? So thinking along those terms, let's also consider how do we calculate maximum profit and maximum loss, right? And so let's build some rules here. Our maximum profit is the amount of premium that we receive. You with me on that? The amount of premium that you receive is your maximum profit. So if you receive, example here. So if you receive, let's say $0.9 or 90 cents on one spread, then your maximum profit is what? Right? That's $90, right? Because we're talking about options and we have to multiply everything by 100. That's the usual deal, right? And what's our maximum loss? Our maximum loss is the width of the spread. So width of the spread, which is in this case how much, right? We have to consider what the width of the spread is. How do we know what the width of the spread is? If we go into the trade, into the option chain, we will find out. But most times for SPX, the natural width is 5. You can go 10, you can go 20 if you're feeling dangerous, but in general it is about 5. So the width of the spread is 5, right? And we minus the premium received, right? I before E before except after C, right? Premium received was 0.90. So that's equal to how much? $4.10, right? 4.10, or if you want to talk in terms of real world dollars, that's $410. So the risk reward on this thing is not so great, is it? Right? It's not so, doesn't seem so hot. Why do people do this? Why do people risk $410 for 90 cents? Yeah, that's a good question. I'm still trying to find the answer, but I think the reason that people do that is because all you have to do is get the right direction. And also, based on historical data, you can see where price is not going to go. This is a strategy of where price is not going to go. That's what the credit spreads are all about. You have to identify clearly where is price not going to go. That is where you sell your credit spread, right? And we'll see that. We'll see that shortly. So we've identified that maximum profit is the premium received. Maximum loss is the width of the spread minus the premium received. And most of the time, people will do a 0 DTE on credit spreads on the SPX. 0 here means that it expires today. So if at expiration, the price of the spread, the price of the underlying did not violate your spread, then you get to keep the maximum profit. Which begs the question, can you close the spread before it expires? Right? That's a $1 million question. Can you close the spread before it expires? That's a good question. Anybody have an answer for that? All right. I don't see any no's. I was hoping somebody would say no, but all right. Okay, yes is the answer to the question. Can you close the spread? It's a resounding yes in all caps. Yes, you can. Should you close it before it expires? Now is the question. Should you close before it expires? Lisa thinks no. Why? Lisa, what do you think? Rochelle also says depends. Should you close before it expires? Amend my answer to depends. Okay, depends on what? Okay.
You want them to unmute themselves and answer?
Oh yeah, please. This is a lively discussion because I'm getting two sides of the answer. So should you close it before it expires is the question.
Depends if you want it to be a full day trade, Eddie, or not. But I don't know if that's the right thing we should be focusing on. It's just what I thought of first.
Okay, so you're thinking in terms of day trade or the PDT rule, right?
For a smaller account.
Okay, all right, that's valid. So if you have PDT restrictions and you don't have any PDT available or you don't have any day trades available, then you might not be able to close it, right? In which case you probably shouldn't have entered the trade in the first place. Any other thoughts?
I said depends. Oh, sorry.
Go ahead, Rochelle.
Oh, I said depends because it's something you taught us before, which is if it reaches the close to your max profit, rather than leave the trade open all day because stock is moving up and down, especially SPX.
Yeah.
To go ahead and close it.
Okay.
And reduce the headache.
Okay. I'm hearing you saying that that's not dependent. That means just close it, right? Okay. Depends on my trading strategy. Okay. I think I like Huan's answer. I think I like Huan's answer. So depends on your trading strategy.
I guess it's your daily goals as well. What you want to make per day or bi-weekly.
Yep. Yeah. Okay. All right. So daily goal depends. PDT rule. All of those are valid because we have different trading plans. So what you're about to hear is what my plan is. Right. Your mileage may vary. My plan says that I have a defined entry and a defined exit, right? I have a defined entry, defined exit. We're talking credit spreads, Shana, all right? So if I sell my credit spread for 90 cents, then I will buy it back. Remember, I sold to open the position, and so now I need to buy to close it. So my strategy says sell and then buy to close as soon as you can. How much should you buy? That depends. I usually buy it anywhere back from 10 cents to 20 cents. And you might argue, why would I buy back from 10 cents? It's almost as good as worthless at that point. It's because from experience, I have seen a trade where the spread reached even 5 cents. Market turned around, went right up, and that trade goes bad. So my experience, and I think I have sold thousands of spreads, is to always buy back my spreads. Should you close before it expires? Yes. Notice I used all caps. I don't argue about it. I close them, even when I am so sure that it is going to expire worthless. Very few times do I do that. And you might argue that I leave a lot of money on the table. Well, the reason I leave it on the table is because I'll be back tomorrow. Nobody's laughing. Man, you guys are kind of cold, man. What's up with that?
I laughed a lot. I was just muted, Eddie.
Man.
I was muted. I was laughing.
Funny.
What's up? It's Saturday. Yeah. Good, Alicia. Thank you. Yeah. That's why I leave money on the table for you guys.
Oh, well, thank you.
Yes, for you guys. Who buys those 10 cent contracts? It's the people trying to correct their situation. You will never have a lack of people buying your spread for 10 cents. So yeah, I always buy back my spreads between 10 and 20 cents, sometimes even more than that, if my thesis is challenged. If I see price moving dangerously towards my spread, I'm out of there. Question is, how many spreads should you buy or sell, and how much can you afford? So let's talk about that. Margin requirements. The word margin here is kind of strange, because when people hear margin, they all of a sudden think, oh, I'm taking a loan to do this, right? I'm taking a loan to this. No, you're not. The margin here is a financial term that says how much liquidity is in your account that will allow you to sell these spreads. Because you're selling, the broker will usually require the width of the spread. So I'm going to say here it's the width of the spread. And how much is that? If it's a 5-point wide, then you need $500 per spread, right? If it's 5 point. If it's a 10 point, you need 1,000, and so on and so forth. I've heard that in TradeStation the requirements are a little different, to where it is the width of the spread plus the amount of premium that you received. I have not verified it. I don't do enough spreads in TradeStation to verify that. I have also heard that in Thinkorswim that the margin requirement is the width of the spread minus the premium that you receive. Two ways of thinking about it, right? So the official answer, I believe, is that it's just the width of the spread, which is 500 for 5-point wide.
Question, Eddie. If you don't want to use margin, can't you trade as much as you want with your own money if you decide not to even have margin on your account?
So that's why I said the word margin here is confusing. Margin here refers to liquidity.
No, but I was talking as far as the PDT rule. You can trade as much as you want if you just use your own money versus having margin on your account.
Yeah, if you have a cash account, but let's not digress. But if you have a cash account, then and also the right level. Let's mute iPad. Yeah. Then yes, you're not subject to the PDT requirements, and I believe that's level 3 on on most platforms. So once again, if you have a cash account, you can trade vertical spreads. Yes, you can. You can trade vertical spreads on SPX. You cannot trade vertical spreads on equities and other securities. Is that hopefully that's clear. Cash account, do you have to wait a couple of days? No, you just have to wait one day. Actually, next day you can do that, Nicole. So that's the beauty about cash settled indexes or cash settled securities. So, and that's why we're talking about SPX, because it is cash settled. Another one that is cash settled is the RUT, the NASDAQ. Those are some examples of cash settled indexes that once you trade, even on a cash account, then that money is available the next day. On equities, you have to wait 2 full days on a cash account. If you have a margin account, that money is available immediately. That's the benefit of a margin account, because then you can trade as many spreads as you want without having to tie up your capital. Okay, so that's the margin requirement, the width of the spread. How many should you do? How many spreads should you do? This all depends on your trading plan, right? Depends on your trading plan. I would suggest that if you're starting off, maybe start with just one contract, right? Yes, one contract. Even if you have many zeros at the end of your account balance, before the decimal place, that is. Yeah, if you're starting out, just do one contract, right? Don't do two. Just one. Understand it, right? Let's see. How do you manage risk, right? How do you manage risk? And why am I typing on my screen today anyway? It's so that you guys can take screenshots or write the notes, or maybe I wasn't clear. So how do you manage risk? If you receive 90 cents credit, right? If you receive 90 cents credit, how much should you risk? Right? What's your loss management plan over here? Deborah, what do you think? What's the loss management plan? All right, I thought she was going to say something. So my plan is that I like to have a stop loss, right? I like to have a stop loss of 1x, right? How much is 1x? 1x is actually $1.80, right? $1.80. And if I have a stop loss of 1x, how much will I have actually lost, right? So 1x, I'm going to say that is 1.80, which means that I will have lost 90 cents. I will have lost 90 cents or $90, meaning that the $90 that I received in credit, I am going to give it back. And in addition to that, I will give you $90, right? $90. So that's 1x. If you have 2x, it means that it's 180 plus another 90. What does that give you? Too bad that I have to go to my calculator, and I didn't even do common core.
2.7.
Yeah. Anybody know what common core is?
New math.
New math. It's more like broken math.
Yes, unfortunately.
Yeah, and I'm a homeschooling parent, so I know all about it. So, let's see. Yeah, so 270, right? Meaning that you will have lost a whole $180. Is that painful for you? I don't know. Maybe not. I don't know. Do I let it go to 270? Depends. Very rarely. But if I do let it go, then something's not working right. Do I need to lose that much money to know that I'm wrong? What do you guys think? Right? At which point do you know that you're wrong? right? When you're hitting 1.5x, 2x, some people actually go to 3x. I've seen some people go to 3x, and for those people, I think 3x, I think it's painful. It's really, really, really painful. And that's why I say you should go one spread, because if you're planning to go with a 2x stop loss, then you're giving everything back times 2. And so if you had 10 spreads, that's a lot of money. If you had 10 spreads, you're talking about giving back $1,800. So position size is super, super, super important when you're talking about spreads. Right? Okay, so that was risk management. When do you take your profit? I would say if you sell to open, so we'll say if you sell to open, that's what that STO means, 0.9, then buy to close, or BTC, at 0.20, and that profit means what, 70 cents, 0.70. You might be wondering, if this is the very first time you're hearing about spreads, you might wonder, you guys are doing all this work for 70 cents, 50 cents. What's all that about? It's because we are always trading spreads in volume. Yeah, some people will trade 5 spreads. Let's use an example of 5. If your profit was 70 cents on 5 spreads, how much of a take home is that? Anybody care to do the math? 350 American. Yep.
Yes.
350. If you do that 3 times a week, about how much is that?
1,050.
Mm-hmm. Yep. Lisa says that's 150 lattes. Wow. Okay. Well, at least she said lattes, not kombucha. But yeah, that's 1,050 a week is not bad. Is it bad? Right? It's good, right? How much do you need to trade 5 spreads? This is quiz time.
2,500.
All right, 5 spreads require. What did you say? 2,500. Yep. 5 spreads require 2,500. So this is a small account strategy, right? So if you have margin and you have $2,500 and you know how to trade the SPX, and you can trade and you can figure out the direction relatively easily, then can you make 1,000 every week?
Yeah, 2 questions up, Eddie.
It's very possible. Okay, yeah, let's take a break. Let's take those questions.
Okay. Mahia?
Hi, can you hear me okay?
Oh yeah, loud and clear.
Okay, perfect. So my question, I think when you put stop loss at 1x, I'm thinking that's the 90 cents times 2, how you're getting the 180. Is that correct? Okay.
Yep.
And where is the 90 cents? So 90 is the max profit. So where did I'm so sorry. So I'm confused as to why I'm taking the doing 1 times the 90x, 1 times the 90 cents. I'm so sorry. I'm having you repeat yourself. I apologize.
Oh, that's okay. So your question, if I may rephrase it, is why is 1x 180 and not 90, right? That's your question. That's the disconnect, I think.
Yes.
So think about it this way. I sold the spread for 90 cents. If I buy it back for 90 cents, would you consider that 1 time or 0x? That's my break even. It's 0, right?
Yeah.
So 1x would be another 90 cents. Right? So if I sold it for another 90 cents, which is 90 plus 90, that's how I get the 180.
Okay, but why would the stop loss go there if the 90 cents is the max profit? So I'm just reading through it. Could you just really quickly do a refresher on this? I apologize again for making you repeat.
Oh, no, that's all right. I mean, your question is, I think you're asking for a lot of people, which is great. And we're trying to understand what our risk management strategy is here. That why would I pick 180 instead of 90 cents? Well, if I sold it back, or if I bought it back for 90 cents, then I actually haven't made any money, right? I've just spent a bunch of money for commissions.
Right.
That's break even. When I set my, remember, we're selling high, buying low.
Right.
That's the strategy. So my high is 90 cents, and my low, best case scenario, would be 0, but 20 cents in this particular case. So if the price goes above 90 cents, the price of my spread, or the value of my spread, goes above 90 cents, I start to lose money. You with me? I'm starting to lose money when the value of my spread is increasing.
Okay.
So how much pain can I tolerate if the price goes up to 150, for instance? Right? Let's do the math here. Right?
Okay.
If price goes up to 150, how much will I have lost if I closed it at that point?
60 cents.
60 cents, right? So I'm giving myself room to breathe and saying that if it doubles what I got, what I received for it, that is my pain point. So let's do another example here is, if I sell to open and I receive 70 cents, my stop loss is going to be what? Right? My stop loss is going to be, if you're doing it the Eddie way, it's going to be $1.40. Right? That's 1x. Because I am giving back the 70 cents that I received. And in addition, and on top of that, I'm giving you another 70 cents. At that point, I am like, that's it. You're not getting any more of my money. Right?
Okay. Right.
And so that's my pain point. That's my risk management plan. Right? That's my risk management plan. But I will give you a tip. Never ever set a stop loss greater than 2.
2x?
Yeah.
Okay. So follow-up question. Where is, I think you did the take profit one too, but which one is the take profit?
My take profit is going to be 20 cents, right? So if I sell, can you follow my cursor here?
Yes.
Right? I've highlighted that line. Right?
Okay.
So my buy to close BTC is 20 cents, or whatever the case may be, depending on what the market is doing that day.
Buy to close. Okay, I see it. Okay, I
right.
got you.
So Mall is buying to close at a value of approximately 20 cents. There are days that I will sell to open at 90 cents, and the market turns around, and I ended up selling it or buying it back at 85 cents or even 90 cents. I close it at break even. Why is that? Because the market has turned around and the trade is no longer good.
Okay.
Right? Are there days that I let it expire? Very few. Maybe 10% of the time that I let it expire worthless.
Okay.
So I always buy my spreads back. One other point, which is, I think, super important. Even though we know that the max loss is defined, in which case in this, let's go with the 90 cents credit. We know that the max loss is $410. And you sold one spread, so your potential gain there is $90. Maybe you buy it back at 20 cents and you get $70. But the trade turns around and you decide, whatever, it's only $410. I'll let it go. It's a bad idea. It takes too long to make $410. And on top of that, you have absolute control of the trade at all times. So don't let it go to max loss. Whatever you do, don't let it go to max loss. You say that one more time. Don't let it go to max loss. Buy back. Right? Buy back.
So I'm so sorry. One final question and then I will get off. But just the 90 cents, if that is my break even, why not, if I know past my break even point, I'm losing money, why not get out at my break even at that point?
Because there's a likelihood that the trade can turn around.
Okay, I see. Okay,
Yes.
I got you.
Most times you will be able to turn around, and when we do go into the example, we'll do all that and see exactly how that's working. So we'll definitely see that.
Thank you.
You're welcome. You're welcome. I think we have a couple more hands up.
Yeah, we do. Shalita, and then I have one question I want to read over for you.
Sure.
Hi, Eddie. This is Chalita. I had a question about something that occurred to me a few times this week when I was practicing verticals in my sim. I was setting I'm in Thinkorswim, so I was setting my buyback order. I know you say 20 cents, but I was a little greedy and I wanted to do 10 cents for a buyback.
Okay.
Which was working out fine. However, there were a few times where I set the order and then I ended up buying it back at like a -5 cents. So therefore I got an additional credit of like a few dollars. Is that just a glitch in the sim, or does that happen in live? Or I just wasn't sure when I saw it buying back at less than zero and giving me a few more dollars than the premium that I had initially collected. Can you just explain what that is?
No, I think the keyword there was sim, right?
Okay, gotcha. Okay.
Yeah, keyword there is sim. I mean, when you go to the market and you want to buy some tomatoes and the farmer says, you know what, don't give me your money, I'll give you some money, and those are pretty bad tomatoes, don't you think?
Right,
Yeah.
right. Okay,
Yeah.
I was just double checking because I do see sometimes when I look at the option chain, I see like when you're like way far away from price, there's like -5 and like these negative numbers,
That's
but I
equal to
didn't think
zero.
they would honor that.
No, they would not. In live, you will not see, that will not be honored. In fact, even on TradeStation, on Thinkorswim, if you go to the chain right now, you will see some numbers actually do have negative numbers, right? It just means that they are approximately equal to zero, right? So 0.5, sometimes you will see during the day, it goes up to like, you start seeing negative in front of the numbers. It means you can't buy it, you cannot buy it, you can't trade it. But if you're in sim, I think somebody said here that it will make you think you're a millionaire.
Right.
So yeah, forget sim.
Okay, thank you. But at least I have the strategy down. I just wanted to make sure that little extra $5, because when I do the math, it was like throwing me off. Like, why did I get more money? So thank you so much for clarifying it.
You're welcome, Chalita. All right. What's up, Shayna?
Hi, Eddie. Hi, everyone. Eddie, I have a question. Can you go over how you go about selecting your premiums, as far as, are you looking at the day frame when you're selecting your premium, or are you looking at where current price is at that time?
Yeah, we'll go over that. I'll definitely go over my strategy, and it's not just my strategy. I think it's a lot of people's strategies, but we'll go over how to identify what is the correct place to sell that spread.
Okay, thank you.
You're welcome. Okay,
Eddie, I wanted to go over a few questions that were direct message, and I think you're going to hit them later, but I just want to make sure before you take the next ones.
Yeah.
And I think it's Maisha. Last time you were going to do this, she had a baby, so she wasn't able to see. On Thinkorswim, placing the trades on Monday, Wednesdays, and Fridays. And she has a lot of background noise, so she didn't want to come and ask if you can do that when you place the trade.
Okay, she wants to know whether we do them Monday, Wednesday, Friday. Is that?
She wants you to do an example of it. I'm sorry.
Oh, okay. Yeah, we'll do an example. Yeah.
Okay.
Yeah. And tell her congratulations on the baby.
Yes, I was telling you, congratulations on that. And let me see, what was the other one? Someone direct messaged me. I don't see it right now. I have to find it.
Okay.
So go ahead. Let's just take. I think it's Arlene. Is Arlene next? Or did we have somebody?
Eddie.
Hey.
So I have a question. I did a live trade in my Thinkorswim account yesterday. I did a vertical put on Moderna, and my strike price. I'm not sure if I entered my short leg and my long leg correctly because I'm losing money even though Moderna fell a lot yesterday. So I'm not understanding why I'm losing money if Moderna fell. My long leg is at 500 and my short leg is at 510. So I'm wondering, did I enter them correctly?
I don't know. What was your short leg?
My short leg was 510.
Okay, and your long leg?
500.
So how much premium did you receive?
Hold on, I'll tell you right now. $26.91.
So you received $26.91?
No, well, yeah, and then it's 2,691.
Okay, you paid or okay, so you received.
I received it.
How many contracts are these? Is this just one?
I did 3.
Okay, all right, this is 3. What's the current price?
Moderna closed yesterday at $432.90.
And the expiration is when for this?
The expiration that I chose was October 8th.
Okay. So this was a credit spread or was this a?
It was a put.
Put credit spread?
I'm a little confused. So I did a put, a vertical put in hopes that the price would go down. So that would be a debit spread, right?
Yeah, this looks like a debit spread because if the current price, no. Current price. What was the current price at the time that you?
I don't remember.
Okay. And these are puts, right?
Yeah.
Yeah, you're deep in the negative right now.
Yeah, I'm thinking I did this wrong when I entered the trade. Like,
yes, yeah, this is wrong. So hit me after this. We'll talk about it because this should have been calls. So
I should have bought a call and sold a call.
Yes, if the current price was anywhere, close to 500, then based on what you're explaining, this should have been calls. Unless the price fell dramatically and fell straight through. So we'll have to look at this one a little bit later.
Not just that, you just never would have, to receive a premium of $2,600, that's unheard of.
Yeah, that's why I said, was this a debit call or a
Yeah, I might have said the wrong word.
Yeah.
So can I hit you up after this call so that we can
Yep, please do.
All right, thanks, Eddie.
You're welcome.
Are there hands up? I have a follow-up
yeah.
on that same question. Okay, let me raise my hand.
Okay, yeah, Denise next.
Oh, hi, Eddie.
Hey.
I have a question. The 5 where you have 5 spreads require 2,500.
Yep.
Isn't that is 5 minus 0.90, which is 410 times 5? I got 2,050. I just want to make sure. Calculating right.
Say that one more time.
So the bottom where you have 5 spreads require $2,500.
Yes.
It's the spread, right? Which is 5 minus 0.90 cents, correct?
No.
No.
The margin requirement. Let me finish that sentence here. So 5 spreads require $2,500 margin, assuming that these are 5-point wide spreads, right? Times 100 times 5. So let's break that down. If it's 5-point, it is times another 5. If it's a 5-point wide, then each spread is 5. Let me write it the correct way. It's 5 times 100 times 5, right? Remember, 5 points is equal to 500. That's why I did the 5 times 100, and then you've got 5 spreads. So that's 500 times 5. That's what gives you that 2,500. That's just the margin requirement, the liquidity requirement for you to trade 5 spreads.
Oh, I see.
Yeah. Before we get into max loss or max profit, that's just how much money you need in your account in order for you to be able to trade 5 spreads that are 5-point wide.
Okay. I thought that has nothing to do with your max loss.
No, max loss. Okay. We discovered that max loss is right over here. Hopefully, you can still see my screen and my cursor here. I'm highlighting it now. That much. And if you were going to do the example on 5 spreads, then it would be $410 times 5. You do the math. That would be approximately what?
Yeah, 2,050.
Yep,
Yeah.
2,050.
Okay.
Yep.
All right, thank you. No, I thought that was the 2,500. That's why I wasn't clear. But thank you for clearing up.
Well, good question. Good question, though. Thank you.
Real quick question, Eddie. Someone's asking or making a comment just to verify. Vertical trades are. They said, wait. In a vertical trade, you are watching the option chain, not the 15-minute chart.
I'm watching both. Watching everything. I'm even watching my neighbor cut the grass. Sometimes it's just too loud.
Eddie. Eddie. So yeah. Steven's next. Hi, Steven.
Hello. How you doing? Up, man. For real, you cracked me up.
Hey, Eddie. How you doing?
Hey, good. How you doing, Steven?
Good. All right. So I'm looking at your you sell or open 90 cent, and then you buy the close at 20 cent.
Yep.
Your 20 cent is determined by where the market is at that time, or how do you come up with the 20 cent?
I pulled that one out of a hat.
Oh, okay.
Yeah. It was a baseball cap actually, but yeah. That's just my trading plan, and you can come up with the trading plan anyhow you like it. So what is your target profit is a question. If your target profit is let's do an example here and say you're trading 5 spreads and you want to make $250, then you're just looking for 50 cents, right?
Right.
And how do you get 50 cents out of 90? You buy it back at 40.
Right.
Times the 5 spreads, you've got your $250. So it also depends on how the market is behaving. There are times when you're in a spread that is just going the wrong way, and you wait for that small pullback and you decide, if it hits 40 cents, I'm out of here. Heck, you know what? If it hit 45, I'm out of here too. Right? And you just get out because you don't want to go into the red. All indications are that market has turned, and we're going to look and see what are those indicators that tell us that the market has turned. You have to be in tune with everything going on around you, and that's why the answer to that question a few minutes ago of what do I look at is I look at everything. Right? I am looking at the Dow Jones. I'm looking at ES, which is the futures. I'm looking at NASDAQ to see what it's doing, and all those things are informing me about how the market is behaving. Because SPX is representative of the market. And so everything that happens in the Dow and the NASDAQ, the futures, is affecting my trade. So, I know it was, kind of a joke there, but really, I do look at everything. So.
Okay. So depending on how the market is going, you're looking at it. If it's going in good the way you want it to go, well, then that's like the more you can you can buy it back for less.
I can buy it back for less, yes. And the reason I picked 20 cents is because I have discovered that 20 cents is easy to sell, right? Because there's people who've got strategy for, trying to buy sure spreads or selling sure spreads. I'm the guy who's usually selling into them for 15 and 20 cents. To me, the reason I buy it back for 20 cents is because I am out of that trade. I have also met my target, and I don't have to worry. On top of that, I am in my trade 15 minutes, 20 minutes, 30 minutes. So my strategy says I'm in the market 9:30, 9:35, give or take, 9:40 at the latest. And by 10:30, I am out. I am out. So
doing it this way, buy the clothes and at this price, it's enticing for people to buy that from you at 20 cents, and
right.
you get out and make your money.
Exactly. It's still valuable for some people.
Oh, okay.
Yep. Make it marketable. So.
Okay.
Yep.
Thanks, Eddie. That's a good question. Quick ones on here. It says, do you have a standard percent where you take, the things are moving. Do you have a standard percent where you take your profit? And just to clarify, it's better to do verticals when the VIX is high. And then Elaine is next.
Okay. So when the VIX is high, it just means I make more money, right? VIX is high is a good thing for me. It's a perfect thing, because then I can get premium so far away from the current price. And that is why I like VIX of 25, 26, 27. VIX to the moon is what I say, right? VIX to the moon. But once I sell it, then I want VIX to come down a little because I want the decay to happen. So, all right. Did I hit all those questions?
I think so. And the other one was, yeah. Oh, the percentage. What's your standard percentage that you take profit?
I don't have a percentage. Anywhere from 20 cents to 0. It's very hard to buy it back for 5 cents. It's extremely difficult. 10 cents is realistic. 20 cents is, it's optimum. Yep.
Great. Okay,
Yep.
Next question. I think is it Yolande? I'm sure I'm messing up the name.
Elaine? Did you say Elaine?
Elaine, yes. Can you unmute Elaine if you have a question?
Yes, I do. Hi, Eddie. Thank you for spicing this difficult class with humor. That helps. Listen, I face a situation during the week where I want you to buy a vertical, a call vertical, and then it said that, okay, I would purchase it for 11.80, and then the spread, and then the other one, the bid was minus 580. Then it said that I could purchase it for 277.
What was the expiration date?
The expiration date was October 20, I think October 21st, the third week of October.
And this is on SPX?
No, it was in Amazon.
Okay, so you're talking about a credit spread on Amazon, or was it a debit spread on Amazon?
It was, but a call debit spread.
Okay, we'll talk about that one some other time. Today we're just going to concentrate on the credit spreads.
Oh.
Yeah.
Oh, okay. All right.
Yep.
So I was paying for it.
Yes. In a debit spread, you pay to get in. In a credit spread, you get paid. So today we're talking about credit spreads.
Okay. Then in that case, I have a question.
Okay.
Oh, no, it's a credit spread. No, that will be for another time. The question will be for another time. It's just selling a call. So, and sometimes what's the margin requirement for selling a call? Can you answer that, or should it be for another time?
Okay, it's the five spreads. So one spread requires, if it's a 5-point wide, you need 500. Are you reading my screen, by the way?
No, I'm not
Then yeah, then you're missing out on a lot of stuff that I'm sharing on the screen. So, okay.
Yeah, okay. All right, no, it's for a put or a call, not a spread. Okay, it's a single, for a single.
Yeah, you just need the amount of money that the premium is going to cost you. So if the premium is going to cost you $2, then you need $200 in your account to be able to buy a call worth $200.
Or to sell a call. No, and how about selling?
Selling is different. Again, let's not digress too much because it's going to confuse a lot of people. If you don't mind, let's put your questions over to the end of this session. Then I'll be able to go into a little bit more detail. Is that cool?
All right. Not a problem. Thank you.
Awesome. Thanks, Elaine. I'll be sure to help you on that. So.
Great. Thank you, Eddie. We have New.
Yeah, we need some new people.
Oh, wait, New just went away.
Yeah, so I was going to ask at the end, but I'll just ask really quickly. And then if you can maybe answer now or at the end, it's okay. So I got the impression, and based on what you said, that you only, when you're selling a put, the maximum you make is the premium, right? Okay, and is that the same even if it's a vertical? Because I did a vertical sell put where you sell to open and buy to close, and at the end of the trade, it said my profit was when you look in TradeStation and it keeps showing you what your maximum profit is as the price changes, and the price had gone from when I bought it at 44.48 to 44.55 when I closed, and it said my profit was 28.50. So is that wrong?
You are partially correct, but I think you're mixing apples and oranges here. So in vertical spreads, when you sell a vertical spread, whether it's a call credit spread or a put credit spread, the amount of premium that you receive, the amount of money that you receive, that is called a premium. And that is all you're going to receive, nothing more, right? That is why it is your maximum profit, okay? And the maximum loss is what you did not receive, right? So the difference between the width of the strikes and the premium received is what your maximum loss is. What I think is confusing you is that when you buy a single put or a single call, your maximum loss is how much you paid for it. Okay? It's how much you paid for it. Second thing to consider is if your put expires in the money or if your call expires in the money and you did not sell it to close it, then it's not entirely worthless. Well, first and foremost, you lost the premium that you paid to get in, right? You lost the premium to get in. So now how much value is left is dependent on whether it expired in the money or out of the money. If it is in the money, then it has intrinsic value. It has intrinsic value. So in your case, you said you bought what did you buy again?
I bought the SPXW at 44.48. Well, no, I sold a put, so it was just like
what strike?
Yes, 44.48.
The strike was 44. What again? 48.
Yeah, 44.48. No, that was the current price. Sorry.
Yeah, it's a weird one.
No, sorry. The strike was 44.30.
44.30, right? Did you sell it to close it?
Yes. So still a vertical, and when I sold to close, it was 44.55.
I'm missing some part of the equation. What were the rest of the strikes?
Okay, so the sell to open strike 44.30, buy to open 44.35.
Okay, so it was a 30.35, and the price ended up at 44.48.
The price ended up at 44.55. So
55. Okay, so above your put credit spread.
Exactly.
And how much did you receive when you sold it?
Said 28.50. Is that the maximum profit?
How many spreads? One? Five?
Yeah.
And you got 28.50? It's an odd number.
But should it even be that much? Should it just be the one,
Yeah, that wasn't a credit spread. Sounds wrong. The most that you could have got for 5 cannot be more than 2,500.
Okay.
So something was wrong. Was this in sim or was this in live?
Sim. Okay.
All right. So you
Eddie,
guys
remember some of the spreads are wider.
Yes,
But
but
it was a
no,
5.
this was a 5-point wide. She said 30-35. The most it could have been was a 5-point wide times 5, which is 2,500. So guys, when you ask your question first, so start with, all right, so I was in sim.
Okay.
Then what had happened was, if you start with that, that will set it right. But if you were in live, I want to hear it. All right.
Great.
Let's see. Rochelle, what's up, Rochelle?
Cool. Okay, so I'm really appreciating all these notes. Could you add in the note a example of what a credit call spread would look like and a put call spread? So what I mean, like you just said, 30-35, that's where I get mixed up. And I think a few other people expressed that too. Like, should it be 30-35 as a credit call spread or 35-30? See what I mean?
Yep. Okay,
thank you.
So the perfect example here. So the person who asked the question before that sold. She was short, right? She was short 44.35, right? Why do I know that she was short 44.35? Because it's a PCS, and she was long 44.30, right? And this is a PCS, right? And closing price, she said was 44.55. So, and she was profitable. In a call credit or in any credit spread. Now this is where it becomes academic. In any credit spread, the short leg is always closer to the current price. Let me write this down. In all credit spreads, short leg is closer to current price when you're selling, right? What is the short leg? That's the one that you're selling, the one that you sell, which means that in all credit spreads, right, the long leg is farther away. I think I already wrote that down, right? Yeah, at the very top. Yeah. I'm repeating myself here. Then, the one that you buy. So that's the premise for credit spreads, and we identified that we want price to go away. We don't want price to come to us. We want it to stay away. Whether it's a put credit spread or whether it's a call credit spread, you want price to go away. So in that example, Rochelle, I believe we said that the short leg here was 44.35 because the price was above 44.35, and that's why we know that that was the short leg. And then long leg, further away from the current price, was 44.30. Does that make sense? She's gone away. Okay. Yep. Hopefully that makes sense.
It does, Eddie.
Okay. All right. Let's answer 2 more questions and then go to examples. How about that?
Sounds good. One quick question over here. Someone wants to know, do you know what the future symbol is in TOS?
In TOS, yes. Thinkorswim, the symbol for the futures. I'll run out of ink here. Let me refill my ink. Okay. Futures is ES. Right now we're trading the ESZ21. Don't ask me what the Z stands for. Right? Let me show it to you on my watch list. So on my watch list, do you see this one over here? ES Z21. It expires in December. Right? So if you want to add it to your watch list, you don't add ESZ21. All you do is just /ES and you hit enter and it is going to pick up the right one. A few weeks ago, just before September 17, it was ESU21. What's the difference? The difference is that the U21 was expiring on September 17. That's when it expired. The Z is the next one, which expires December. I forget what date in December, but it changes every 4 months. Make that every 3 months. How long is a quarter? Is it 4 months or 3 months? It's 3 months, every 3 months. So every quarter it changes. On TradeStation, it's at symbol ES. Okay. Does that help?
Right. Yeah, I'm sure it does. It helps me. It was a quick question. Yeah. Okay, let's take the next question. You said, Kelly Scott, your hand came up a little bit after. We're gonna do a few questions. Eddie's gonna move on and then we'll take your question. Go ahead. Next person, please. I think it is Mahaya. I keep messing her name up. Sorry.
It's all good. Thank you. I just have two quick yes or no questions actually. From my notes. So this is not something that you have talked about in this call just yet. You might touch on it in the future, but I just wanted to know, I have here that says the net delta would have to be less than 0.20 for call credit spread and for put debit spread. Is that accurate or is that wrong?
I think it's wrong. Here you're using the word delta. Delta is referring to, it means something totally different. I think you meant debit.
No, I have here that delta needs to be less than 0.20.
Okay. No.
Okay.
No. So we're buying it back for 20 cents. Maybe that's the confusion. We're buying to close for 20 cents.
Okay.
Nothing about delta.
Okay. So the other question I had was for credit, we need to be out of the money. And then for debit, it doesn't matter. Is that accurate?
For
credit, we needed to be out of money. For debit, it doesn't matter if we're in the money or out of money.
Are you talking about debit spreads or credit spreads?
Comparison of the two. So just about in the money or out of the money. So
understood.
That's all.
Yep. So you're jumping a little further ahead, but I will answer that question. Credit spreads, ideally, you want the credit spread to expire out of the money. Okay. Out of the money, right? That is the desired state. Actually, that's so important that I'm actually going to write it down over here. So let me refill my pen with ink here. Yep. So best case scenario. Now, hopefully these notes are helping somebody. Spread.
They're amazing, Eddie.
Okay, great. Glad somebody's liking them.
Very helpful.
Awesome. Spread expires out of the money, right? That is the best case scenario. Worst case scenario. Need a new job. Okay.
No.
What would Eddie do?
All right. So what does out of the money means? Out of the money means that you want it to expire with a value that is next to nothing, actually nothing. Why? Because you can't buy it back for anything. Let's consider this for a second and understand why that is so important. Remember, the thesis is we buy low, we sell high. In this particular case, we're selling high, and so we want to buy low. What's the lowest that you can sell it, that you can buy it for? All right, 0.01 cent. So if it's worthless, that is what it means out of the money, right? It has no value. It has no money. that is the best case scenario. It means that you don't have to buy it back. You get to you get to keep 100% of what you received, right? If it expires in the money, it means that it has value, and therefore you're going to owe some money. You're going to have to give back some of the premium that you received. So if you sold a call credit spread for a put credit spread for 44.35, 44.30, and the price ends up somewhere between 35 and 30, I'm referring to 44.35 and 44.30, say 44.32 and a half, that's probably your break-even point, right? And when you sell a spread, it's going to give you a break-even point. So that is a halfway decent scenario. If the price of this underlying fell and past 44.30, yeah, that's the case where you need a new job, because it's not working. Because now you've suffered maximum loss, and you should have gotten out of that spread before it hit 44.35. In fact, that's a good question, because we should talk about what are some of the defensive strategies that we can take in order to defend. What if you didn't have a stop loss, right? You're one of those bad boys that doesn't believe in stop losses, or you just forgot your stop loss. You can roll the spread. Now that's an advanced strategy. You can roll it to the next expiration date, or you can roll it up in strikes. That's a whole different conversation. I probably need to do some examples on that. I think I've done at least one example. Or you can, yeah, I think I'll stop there. Those are the two things that you can do. The best defensive strategy for vertical spreads is to get out of it. The next best scenario is to roll the spread. There are very few scenarios where it is advantageous. When you roll the spread, you want to make sure that you roll before the price reaches your short leg. Before the price reaches your short leg. And that way you can roll it to the next expiration or a different strike price for additional credit. It may work out to your advantage. I have done it both ways. If your short leg has already been breached, then the most that you can do is roll it for a debit. At that point, you're really just delaying the pain, right? You're just delaying the pain. So that's what that is. So, all right, let's go on to examples. How about that? Has everybody got their screenshots?
Hold up.
Wait.
Got it, Eddie. Thank you.
All right.
Wait a minute. Okay, I'm good.
All right, you're good. Everybody good. All right. So I am going to delete these, and I'm going to clear all drawings. And let's talk about this. So in this particular example here, where we say that the price is 44.55, and we think we're going to do both examples. We don't know what SPX is going to do Monday. So these are just examples. And I'm going to look for premiums somewhere around 4,400 for PCS. I'm going to start with a PCS, right? And then we're going to do another example using a CCS. PCS, remember, stands for put credit spread. When you're selling a put credit spread, you're saying that the price is going to remain above, right? Price is going to remain above your short leg. So our short leg, let's say our short leg is going to be around 4,400. Let me make that exact 4,400 so that you guys can see it. Yep. And let's edit this one, make that one 4,500 exactly, because we're going to come back to it. 00. Okay. And the current price right now is 44.55. So let's go to the option chain and see what's available. First and foremost, how do I get to that option chain? How do I set it up such that I am looking at the proper option chain? By default, your spread says single. Okay. By default, your spread says single, and we've decided that, you know what, we're going to sell for our put credit spread, we're going to sell the 4,400 and we're going to buy the 43.95, right? 4,400 and 43.95. So let's do this fast for our Canadian friends. 4,400 is not even on the screen. So let's increase the number of strikes that we can see. Let's go to 30. Yep, I can now see. And we're going to do a put credit spread. So we're going to be on this side. I forgot to mention one thing. When you're selling vertical spreads, you sell them out of the money, right? You sell them out of the money. And your thesis is that they will remain out of the money. That's the best case scenario. Remember, we said the best case scenario was for them to expire worthless. The only way they can expire worthless is if they are out of the money. So for our put credit spread example, we are going to sell the 4,400 and we're going to buy the 43.95. Well, how do you sell 4,400? I'm going to click one time on the bid column, right? And I'm going to hold my control key and I'm going to buy the 43.95, resulting in a net credit of 25 cents. Is this worth it? Probably not, right? Probably not, because 25 cents is too miserable. Can't even sell it back, buy it back for anything. Maybe maybe let it expire worthless. But you don't want to do that. But we'll just assume that, our example gives us, a decent profit. Let's say we buy it for 75, sell it for 75 cents, right? That is how you do it manually. Look at what I'm doing here. I am selling, if you can follow my cursor here, I am selling the 4,400 and I am buying the 43.95. You with me? Right? If I were to do this the automated way, I would simply go to spread vertical. I would look for the 43.95, 4,400, which is that one. And I would press the bid column. That should give me the same thing, 25 cents. Do you see that? Close some of these things, 25 cents. So I did that for the benefit of our Canadian friends who do not have a layout that is similar to these. What is a more realistic premium to get? What is a more realistic area to get? I try to go at least 3 or 4 dip, out of the money. So 44.35, 44.40 will at least give me $1. You see that? Right? I went to 44.35, 44.40. What is that saying? I'm selling the 44.40 relative to the chart. Let's draw 44.40 here. 4440, and I'm going to give it a dashed line, that one. That's too close to the money. That's 15 points away from the money. That's living dangerously. I don't recommend living dangerously. And I also want to say that the closer you get to the money, the more premium that you can get, but also the more likelihood that your strike or your spread will end up in the money, in which case you're standing to get maximum loss or a really horrible loss. And that's why we go further away from the current price. Well, what's a good rule of thumb? How do we know how far to go? Well, if you go to your platform, most platforms will tell you what the expected move is. So let me delete that. And if you're looking at my Thinkorswim platform here, do you all see this right column, this right data over here? Right? Let me see if I can draw something around it. I just drew a red box around that. Did you see that? Can everybody see that? Nobody can see that.
Yeah.
Oh, all right. It says plus or minus 28.27. What does that mean? That's the expected move of SPX on this particular date of September 27, right? And each date has got a different expected move. How accurate is this? Not very accurate, right? Not very accurate because it depends on what the market is doing and what volatility is. This is in fact called implied volatility of 9%. So this is just a guide. But how does it help me? Why do I look at it if it's not useful? Well, it is useful in the sense that I am now trying to understand what is the likelihood or how will SPX move relative to what this information is. So if the current price is 44.55, I'm going to round this up to about 30. Then I know that SPX will probably move plus or minus 30 points, and that's how far away I need to be. So 44.55 minus 30, right, is 44.25. Well, that's still too far away. There's no premium there. Well, maybe there is. I don't know. Is there premium? Let's see if there's premium at 44.25. There's about 60 cents. Yes, there is premium. I like this. So when I'm making a decision, then that will help guide me in terms of how far away I need to be. And that's why I look at that number. However, I don't look at it the night before. I look at it in the morning, right? Because that number is going to fluctuate. So you need to look at it in the morning, not the night before. In fact, I don't pay attention too much to things the night before. I actually look at things in the morning between 8:30 and 9:30. That is when it is most helpful for me, because I will see what is happening with the overnight futures. Right now, the futures are trading. I can see we are up 8, and this just tells me that we might open up. It doesn't say that we're going to open up, but it gives me some direction. Remember that SPX follows the ES. The ES in turn follows what the Dow is doing in the NASDAQ. So that is why I watch that. Let's do an example also using. I think Teresa's got. Okay, there we go. Let's do an example using the CCS. So the CCS, we're going to look for premium above 4,500. Right, or 44.80, I would say, because we've identified a potential move of about 30 points. So anywhere 44.80 and above is where we're going to look for premium, and let's do that. So this time I am on the calls side of the option chain, and I'm looking for anything above 44.80 that still has anything. So I see the 80.85 actually does have about $1 in premium, which is great, right? Which is great. So your strategy can be to sell a CCS or sell a PCS. Which one is better? Here's how you decide. If the market is going up, you sell a PCS. Let's write some notes, right? If market trend is upwards, sell PCS. And of course, if market trend is down, sell. I'm typing slowly, man. I'm a bad typist, man. Oh, this sucks, man. I need some typing classes. Of course,
you're making that money. It's all good, Eddie.
I know. I should probably hire typists. Do those still exist?
I type over 120 words a minute. Hire me.
You need better things to do. 100 types, oh man. You type that fast? Good. Why don't you just hire Siri? Love it, love it, love it. Thank you, Lisa.
Anytime.
Actually, I do type very fast. It's only about when I'm being watched, I type terribly. So if the market is trending downwards, sell a CCS. If market is upwards, sell a PCS. Is that simple? Does that make sense?
Yeah, it does.
Yes.
Yeah.
Yeah. Because you can do both. It's a question of which one is the right one, right? Which one is the right one? And the right one is dependent on what direction the market is going. And the reason we don't want to sell a CCS when the market is going up is because if it's going up, it means that our spread is going to be challenged by the time market closes. So we don't want to fight against the trend, right? We want to fight against that. Let's do that example again for 43.85 for our Canadian friends. So we decided that we're going to sell the 80 and buy the 85. Is that what we decided? Right. Let's do that one more time. And I'm going to clear my screen again. Hit that. Go here. Yep, we're going to sell the 80 and buy the 85. How would you do that? So you would, again, on the calls side, first you'd be in single. And you would go to the 80. You're going to sell these. Remember, the bid column is where we're selling. So I would push 320. I would hold down my control key. I would go to the 85 and buy that. Right? Push on the 245, and that's what builds it. So you can see how that builds my vertical spread if I have a platform that does not have the vertical layout. Believe it or not, in 2021, we still have platforms that don't have that. Yes. So,
Eddie,
yes.
Eddie, it's Anita.
Yes.
For the Canadians, yeah, with IB, you will get a note up the top that says you're getting a credit.
Yep.
So it does help you, know that you're going the right way.
Okay.
Otherwise, it'll show debit.
Yep.
So if you know you want to sell and you're looking for a credit, that's what you want to see is, and it's green versus the blue debit.
Okay. Good to know.
So there's a little bit of a safety as you build your own.
Awesome. That's good to know. So, and the reason I'm going into so much trouble explaining that is because there's a significant number of people in Canada who do that. So not to forget our American friends here, let's do it also in TradeStation, right? Let's do it in TradeStation. Anybody care about these or not? Should I just gloss over it?
Please do.
That was a good joke. All right. So I'm going to go to the option chain and I am going to push $SPXW.X. All right. What's with the W? W says weekly, right? Weekly. Not to be confused with the ticker symbol SPX.X, which is the monthly. Right? So it's always the SPXW.X. I mean, you can do the other one, but there's no warranty on it. So how do I sell a 43.85.80 call credit spread on TradeStation? First off, I am going to push this single drop down over here, the spread, and I'm going to select vertical. If on your screen you don't see vertical, just go ahead and click on all or mouse over all, right? All, and then move to the left and just scroll down. It's the last item. It says vertical, right? Select it and notice that my strikes are going to be now displayed in this column over here. Right now we're looking at 5-point wide spreads. What if you wanted to sell a 10-point wide spread, right? You'd select strike, interval, you'd choose 2. Notice that now I have got 10-point wide spreads. Why do you want to do that? You probably have a trading plan that I need to hear. Some people do. It makes sense sometimes. Most times it does not. Stick with the 5. So I would accept the defaults, and I see barely the 44.80.85 right here. If I wanted to see more strikes, then I can choose more strikes over here and go to maybe 30, right? And that would give me visibility for a little bit more, a few more strikes. So we want to sell a call credit spread at 44.80, 44.85. So I'd look for it here, and then I'd look on the left side, and on the bid column, I see 0.75. That's the one that I would push. And notice that it gives me that dialog up here at the very top that shows I am selling to open the 44.80 call and I'm buying to open the 44.85 call. And the quantity here is 1. If I wanted to do a few more than that, I can go to the quantity section here and increment that to 5. Okay. I will need to put in a limit price. Look at the mid. That is usually the best one to select. Now, it does not accept prices that don't end in a 0 or a 5. So I need to adjust the price there a little bit. And I'm going to adjust it down to 1. So round it down to 1. Even though it says $1.02. You will not get filled at $1.02. I don't think it will let you even push the order. So I'm going to sell 5 spreads for a limit price of $1. And I'm going to send the orders. Look at that. It tells me that my maximum profit is what we thought it was, which is 500, meaning that it is the premium. Our premium was 1 times 5. And that's how we got the 500, right? And our credit, well, again, 500. Our maximum loss is 2,000. How did we get 2,000? It's because it's the width of the spread minus the premium received times the number of spreads. So in this case, it was 500 minus 1, which gave us 400 times the number of spreads that we're selling, which is 5. So 400 times 5 is 2,000. Does that make sense on that? And it also tells us what our break-even price here is, 44.81. It's saying that if the value of SPX ends up at 44.81, we're neither going to lose nor make money. That's our break-even. Break-even is a hot topic. I see a lot of people getting stuck on break-even. Break-even is only important on 2 occasions, at expiration and on spreads. If you're buying single calls and puts, don't worry about break even, because you're going to sell your sell your call or put before it expires, hopefully. And so you don't have to worry about break even, and you can start making money immediately, right? Immediately. The only time you have to worry about break even if you bought a single call or a single put is if it expires in the money or out of the money. If it expires in the money, then break-even is important, because then you're calculating the intrinsic value, which is the difference between your strike price and the price at expiration for that particular underlying. When it comes to vertical spreads, the break-even point is the point between what you bought and what you sold, the point at which they're going to take some money out of the premium that you received and you're going to give back some. So in this particular case, 44.81 is the break-even point. You don't want to test this, right? You don't want to test this. You want to get out before it reaches this point where you're calculating break-even. So don't get into the business of testing that. That's how you enter an order in TradeStation. Now, unfortunately, you cannot do an OSO or CO in TradeStation, to my knowledge. But you can do that in Thinkorswim. Right? You can do that in Thinkorswim. So let's see, how do we do that in Thinkorswim? I'm going to go to spread vertical. I'm going to select that strike, 44.80, 85. And I'm going to just push one time on that 75 cents. Right? I'm going to push that just once, and it builds that vertical for me. And I want to turn this into a bracket order, right? Into a bracket order. So this is important for people who do it this way. The way you do it is, notice that there's this icon or there's this link down here that says advanced order, and you have a choice. You can pick up all these types of advanced orders. The one that you're interested in is the one that says fast triggers OCO, right? Fast triggers OCO, and I select that one. The next thing I'm going to do, I'm going to right click anywhere in this red area, right click, and just create opposite order. That gives me my exit order, right? I'm not done yet. The next thing I'm going to do is right click anywhere on this green area, and I'm just going to do duplicate order. You see what it says duplicate? Create duplicate order. So now I have one red one, two green ones. What's that all about? Well, let's fix that. The first one is my sell to open order, right? I am selling this spread for $1. I'm getting a credit. That's my sell to open. Remember, we sell high, buy low. So my next order here is the one that we're going to buy back. Guess what I'm going to do? I'm going to buy this back for 0.20. That is my buyback order, right? For a profit of 80 cents, 1 minus 0.2. That is my buyback order. So that's my, I also call it my take profit order, right? And what's this third one doing over here? Well, this third one here is my stop loss, right? This third one is my stop loss. And so I have decided that, you know what? Pain point of $1 is just as good. If I receive $1, then I am going to have a stop loss of 2. And of course, I need to change this from limit to stop. Make it a market order. I am so explicit about this. This is the one time that I do market orders. No other time do I do market orders. Trust me, I don't do them. I don't do market orders. I don't do market orders except on spreads to get out, right? At this point, if it's approaching 2, this is a really bad situation. I want to get out. Get me out now. So I don't want to gamble by even putting a limit on. Just get me out. This is the one time that I do market orders. All other times I'm like, meh, you know, just chill. You know, let it hit when it hits. Okay. Questions on this order? Let me reduce these so that you all can see that.
I have a lot of questions going on.
I have a lot of questions. Okay.
You do. And
right.
Some people want some recaps on a few things before you even take the questions. I think it'll be simple.
Okay.
I think they wanted you to break down the explanation of breaking even again, of the break even explanation, and the plus and minus sign at the top where you were showing us, you know, where you put it in the box. I know that was a while ago, but it was typed in, so I just remembered that one. And
okay.
There, then we have beaming.
And then we have what?
The next person with the question, I was saying. Who's next? Oh, sorry, did I mute myself? No, Bima is next after those two things. After you explain. I'm sorry, did I go so fast? Am I confusing you?
Oh, no, you're fine. You're fine.
Okay.
For some reason, I was unmuted. Okay. So, break even. Break-even price is let me hit confirm and send on this one, and you will see the break-even. Well, let's first talk about what break-even is. I got some oranges that I'm buying for sale from a farmer friend of mine. Bought them for about $10, right? Bought them for $10. And I take them to the market. They're selling at about $15, $16, and I sell a bunch of them. So I'm doing pretty well, right? They're just, you know, plain. What did I say? Oranges? Yeah, oranges. Yeah. But I bought them for $10. Now I bought so many of them, and I can't sell all of them. Usually it's pineapples. Okay, pineapples. All right. Nicole. You know, I trade all things. Sometimes it's oranges, sometimes it's pineapples. All right, today it's oranges. I like where you're going. So these oranges are not selling, and I'm like, man, I'm gonna call this farmer up and take your oranges back. How much you want to buy them? Right? How much you want to buy them for? And if the farmer buys them back for $10, right? Will I lose money or not?
No.
Break even. That's break even, right? Right. Yeah. That's break even. But if he buys them for $9, that's a loss. The same thing with your spread over here. If I buy it, if I sell it for $1, and I am unable to buy it back for less than that, then my break even is going to be $1. At that point, what will the price of SPX be? At that point, what will the price of SPX be? And that is what the system is calculating for me and saying that it is somewhere between 44.85 and 44.80, which is where my strikes are. And we discovered that it is $1 from the long leg, right? From the short leg. It's $1 from the short leg, because that's how much premium I received. If my premium received was 65 cents, yeah, let me see whether my thinking is correct here. I'm going to sell this for 65 cents, and I'm going to test my thinking. Then my break-even point should be 44.80.65. I'm going to hit confirm and send and see what this thinks. Break-even is, does it tell me what break-even? Yeah, 44.80 and 65. Do we see that? So it is always going to be your premium received, right, plus what your short leg is. But don't sweat it. Don't sweat it too much. What you want to do is you want to make sure that your price, your short leg, is protected as far away as possible. That's all I have to say about break even as far as vertical spreads. Then we're talking about the expected move, or the implied volatility here. The 28 plus or minus 28.147 is the expected movement of the underlying. Every symbol in this system has got an expected move, plus or minus. Doesn't matter which one you go to. Let's see, VIX. We can see that the VIX on Monday will, not Monday. Was that Monday? Monday's not the 29th. Is Monday the 29th? I'm missing some dates here, apparently.
27th.
27th. I don't know why I don't have all my option chains. Okay, I'm missing a few things. Amazon, plus or minus 78 points. That ought to tell you something, right? Tesla. Anybody trade Tesla these days? 43. AutoZone is 36. Sometimes you will get some additional data, right? You'll get some additional data about what the expected move is. And I'm looking over here at MMM. Do you see these MMM right here above in yellow? Does anybody see that?
Yes.
MMM stands for market maker move. That's what the market maker thinks or believes that this price is going to move, regardless of what your implied volatility is. Pretty darn accurate. It works. So on Monday morning, you should see also a market maker move for SPX, right? But that's what that plus or minus is all about. Let's go back to SPX now. What questions do we have?
I'll go. I think I'm next.
Okay.
Can you hear me?
Yeah, I can hear you, Bemi.
Okay. I have two questions. I think the first question, it was based on what you had said earlier. You mentioned that you enter the market between, you trade between like 9:30 and 9:40. And my question was, I know you're looking at like the futures, the Dow, but I was wondering, could you show like in real time how you look at the futures market and the Dow to determine where you get in? Because I look at them as well, but I'm not sure what I'm seeing, right? So since like the future starts at, I don't know, like maybe 4 a.m. in the morning, are you going that far? So I would love to see how you look at the futures, the VIX, the Dow, and then you enter your trade. I don't know if you have that recorded. That would be like super helpful because you can explain it, but I think like seeing it would be really great. So I don't know if it's a question you can answer now or if that's something you'll answer for later.
Okay.
So.
I'll try the best I can. So the futures trades 23 hours a day, closes between 5 and 6 Eastern time. And because it trades 24/7 and it is a precursor to what the SPX is going to do, then I look at it to guide me what could potentially happen. So let me go ahead and clear this screen here. Right now it's trading. So clear drawing sets. And what I'm looking to see is the overnight lows and the overnight highs to see where did it go overnight, right, in the past. And that's what guides me in telling me that this is approximately how SPX is going to behave. It's not a one-to-one. It's just a rough idea, and it seems to work. Your mileage may vary. However, what this number is, the net change in the morning, is critical for me, and how it's moving. It is important for me in the morning to see, is it positive or is it negative? If it's negative, I know that most likely the SPX is going to open below where it closed previous session. If it is positive, it's going to open above. How much above? About this much above, right? I also follow to see what other things that trade 24 hours are doing, like the SPY. Notice that I have 24 here on the SPY. It's because right now SPY is trading, right? Never stops. This guy's trading 24 hours. So I look at that and I look at ES to see where they were. Additionally, I look at the Dow futures to see what's happening. Let me bring up CNBC, because I know a lot of you also use CNBC, and I look at CNBC as well. Here's an easy way to do it, right? On your app, just go to CNBC app and look at these three boxes, right? Look at these three. Usually they will tell you, they will be green or red, and you will see the numbers moving. Actually, it's going to be in pre-market, right? So this is the Dow futures, this is the S&P futures, this is the NASDAQ futures, right? When the S&P futures are green, it tells me that more than likely this will be, we're going to be opening upwards. Don't look at this today and think that that's what's going to happen Monday. Look at it on Monday at 8:30 in the morning, between 8:30 and 9:30, right? And not the night before. So much happens overnight. The Asian market is still trading, all that good stuff. So here's an easy way to, that's an easy way to just kind of trend or watch the trend of what the market is likely to do. Let's see, what was your other question? Why do I trade between 9:30 and 9:40? Because I have already identified what direction the market is going to be in. I also understand that there's a likelihood that if I buy early in the day, the premium is going to decay quickly. Usually it decays tremendously fast after 10:30, right? So I am buying high, I'm selling high, buying low. There are many times I sell a put credit spread. I am out of it by 10:30, and if you look at it at 10:30, you would wonder, why would anybody do that, right? It's because I'm hitting while the iron is hot. Your mileage may vary.
Thanks, Eddie. So the other question was, when you were putting in like your bracket order for your spread, you did a stop market. Why didn't you do a stop limit? Because I thought if you do a stop limit and you have it as $2, it would get you out of the trade when your premium goes up to $2.
Yeah.
Versus like what the market is, because the market fluctuates so fast, it might get you out of the trade sooner. But just wondering like what your thought process with using stop market versus stop limit.
Yeah, and that's why I say this is one of the few times that I do a stop market. At that time, I'm desperate. I'm crying. I'm on the floor. I'm under my table, my desk. I really just want out, right? And I want out no matter what, because it's really bad. And that's why I do a market at that point. If this was an equity, I might have some leverage. I might have some leeway, some time to breathe, even recovery. But for a vertical spread on SPX, if it hits my stop, I am out. Also, because of the amount of volume, the huge amount of volume that is traded on the SPX, it will usually get me out at my stop market, right? I've heard of horror stories where you set your market at, say, $2 and you got taken out at $2.50 or $3. That is more the exception rather than the rule. On SPX, if you set your market stop at 2, it will get you out at 2. So that's why I'm pretty comfortable. The main thing is I want out. No negotiations. Out.
Perfect. Thank you so much.
Yeah. So.
Hey, Eddie, I know we have a lot of questions. I want to just ask you about the time real quick. It's already 12 o'clock. And don't forget, we have Maisha, who asked a question earlier, our friend who had a baby earlier this month, waiting for us, or waiting for you, I would say, to answer the question about maybe using your simulator to show how you go into the orders and to show your strategy more. She wants to see you actually do it.
Okay, we'll try and get to that. Yeah, today I know I have some flexibility because this is a rather difficult subject, but I do want to make sure that everybody understands it, and at least you get a chance to get your question in. So let's.
Okay, great. So Stella is our last hand up, so that'll be the last question, and then you can.
Okay, sounds good. Sounds good.
Thank you.
I think we answered Bemi, so let me put her hand down there.
Kelly, you've been waiting a long time. Thank you for your patience.
Okay, I just still, and first of all, please, just let us know where you're going to post this, because I know I'm going to have to listen to this a few more times for all the bells to really click. So the delta, the percentage there, when we've marked our zones.
Okay, well, I missed you there. I lost you there for a second.
I'm sorry. I said the delta, the percentage that you showed us in the top right. Once we've marked our zones and determine what we want to get in and get out, the delta percentage, I wasn't really sure how you said to calculate that, because when you did your example, you did the 440, and I guess the current price is at 44.55, and you said we were too close. So I wanted to really clarify how I'm going to calculate if I'm too close there.
Are you talking about? Okay, I think you're calling it delta. Delta is this column. You're referring to.
I'm sorry, the plus or minus 28.
Expected move.
That's standard deviation. Okay.
No, expected move, not standard deviation.
Expected move.
Yeah.
Okay. The expected move is 28.11. So I want to stay that far away
if you
from
can.
the current price.
Yes, if you can. Yeah. So let me just clarify what that expected move is. It's an approximation based on the amount of volume already in place, and orders, open interests, volume, historical data. So it's a statistical probability that SPX will move plus or minus 28 points on September 27, right? Now, it is well known that even when the plus or minus 28 is well published, that we can move 100 points. Case in point, last week, we actually moved more than 100 points, and the expected move was only like 21 or 25, something like that. So this is only a rough guide to give you an idea how far away do you need to be, right?
Okay.
It is akin to using the ATR on SPX. In fact, I'd rather use the ATR on SPX and say that, you know what, it has a possibility of moving 51 points. That's the current ATR for SPX.
Right.
So knowing that the ATR is 51, then I really need to be 51 points minimum away from 44.55. So 4,400 would be correct.
Okay.
Right? 4,400 would be correct. On the extreme, on the opposite side, 4,500 or 4,510 would also be correct. However, is there any premium at those levels? Let me go back here to about 20 points, 20 strikes. 4,500, do I have any premium? Yes, I do have premium, but is it worth it?
Okay.
Is it worth it is a question. So no, it's 20 cents is not worth it. Well, what's a worth it number, you might ask? To me, it is anything that I can sell and buy back and be left with at least 50 cents.
Okay, 50 is our goal. Okay,
That's my plan. That's my plan, right?
Yeah.
Your plan may be different. For me, I'm usually going with whatever I sell, I need to buy it back and be left with about 50 cents at least.
Okay.
That makes it worth it for me. But there are times that I violate that rule, and I don't consider it violating it. It just depends on what the market condition is. If I find that my spread is going to be, threatened, then I'd rather keep whatever I have got, and sometimes that can be as little as, 5 cents or 20 cents just to get out of the trade. I'm trying to get out, at a break even or better. Then I will look for a better entry price. So I have to admit I am wrong a lot of times, but I'm also right a lot of times. This year, I believe I have lost about 3 times maybe 4 times on credit spreads. I've taken a max loss 1 time. That was the only time in my life I will ever take a max loss.
Okay. All right, then. And then you said the MMR, the market maker move.
Yep.
Is that similar to the ATR or?
No, because you can see that in this particular case for AutoZone, which has a market maker move for $6, the ATR is actually 33. So this is again based on the orders that are currently in the system for the next trading day. All right, this is for the next trading day. So, which on Monday, this will be Monday's MMM.
Okay.
There's a deeper discussion on the market maker move that we could go into, but not today. Don't want to confuse a lot of people.
No.
All right, Kelly.
Okay, thank you.
Great, Clavel.
Eddie.
Yes.
Can you, if you have a minute to do so, I know you showed us many times the first trigger OCO, but I know the market, it does what it does. So if, say, with your example, if you didn't get picked up at $1 and you got picked up, say, at 85 cents or 90 cents, but you have already put all those numbers in with the OCO order. So we then would have to go back into the orders and then change it to match the price that, we got picked up at. So can you show us how we would, be able to do that?
Yeah, so you do that in the monitor screen. And I'm going to change here from live to on demand here fairly shortly.
Okay.
When we do the example, we'll see how to modify those orders.
Okay, great. Thank you.
Sure. Make a note of that. Yep. Okay. What's going on, Shayna?
Hi, Eddie, again. Eddie, I wanted to ask you if there's a correlation between where you pick your premium according to where the stock price is, because I just discovered yesterday that you can lose money without even hitting your short leg. So if I'm selecting a premium, do I need to pay attention to where the current price is? So say, for instance, if I sold a credit spread and say, for instance, the price is going down and then it just started to come back up and it passed the point to where I purchased the stock price, like where the current price was, is that where you start losing money? Because I thought that you only start losing money when you hit your short leg, but I see that's not true.
You're correct on that. You can be losing money even if your short leg has not been breached yet. However, if at expiration your short leg is not breached, you will not lose money.
Okay.
So you have to think in terms of what's going on. Why is the value of the spread increasing as it increases as it reaches your or as it approaches your short leg? It could be an indication that your spread is maybe in the wrong position, or you you sold too early, right? So maybe you sold it at, I don't know, 65 cents and now it's trading at 90 cents, but your stop has not been hit and your strike has not been breached as well. And that's why we set a stop loss of maybe $1.30. If you sold for 65 cents and you set your 1x stop loss at 130 and we're trading at 90 cents, there's a chance that it could fall back down to under 65. In fact, if the trend continues all day, the longer you're in that trade and it doesn't hit your short leg, the faster or the more that 65 cents decays or that 90 cents decays, and by the end of the day, that should be equal to zero, right? So during the day, you might see an unrealized loss. It is unrealized.
Oh, okay.
Right? And it is only realized if two things happen, right? If the spread expires at that particular moment in time and your short leg has been breached. If your short leg has not been breached, you're home dry. That's a point in time with which you light up a cigar, preferably a Cuban Havana. Yeah.
Okay, thank you.
You're welcome, Shayna.
Stella? Oh, I'm talking to you. Stella, you have a question for us? You can unmute. Let's try Craig and we can come back to Stella. Craig. Oh, there we go. Craig, do you have a question? We can't hear you. I see him unmuting, but I don't hear him. So maybe you can type it in the chat for us real quick. And let's try Stella again. I see your hand up. Stella. Okay, can't hear anyone. And Rochelle, your hand just popped up. I know I said Craig was going to be our last question, but it looks like we got a little time. So.
Oh, okay, cool. So on that example you just gave, Eddie.
Yeah.
Where you said, I think I got this right. If the spread value increases above the sold premium, basically I would have to buy to close at a higher price, which is how I lost money, even though my short leg wasn't breached, right?
Correct.
Yeah.
Yep. If your thesis was that, or if you had good intel that said that price is going to end up below your short leg, then you could have pretty much just waited out all day.
Okay, so short leg is not breached.
Yep.
Even though the value of the spread has increased.
Yep.
I can wait it out all day, and as long as it closes without the short leg being breached, I get to keep the premium.
That is affirmative. Yes.
Okay.
Yeah. Would I do that?
Would you do that?
Heck no.
Why?
I'm not that brave.
Because tell me, is it because you're thinking, well, the value's already increased, it's not going to get better?
That's because I don't know where the price is going to end up at the end of the day.
Okay.
Yeah, and it also depends how high has it gone. So let's see. We want to do an example now, right?
Right, and Maisha's raised her hand now. She's gonna verbalize it for you so I don't mess up her question.
Oh, okay, great.
Go ahead.
Hi, Eddie.
Hey, how's it going? Congratulations on the baby.
Thank you.
Hey,
Thank
yeah.
you.
How many pounds?
Sorry, that's my little girl.
Oh, that's the other one, right?
Yeah, that's the other one.
Good deal.
Oh my, he was born on August the 28th, 7 pounds, 20 inches.
Yep.
And I remember the last time we talked this, the other Saturday, you said we were going to go ahead and try to practice in the simulator of your thought process on, on the Monday, Wednesday, Friday using the think back, because I think that would be really cool to see it visually. So that was actually my question, how you say you get in from between 9 and 9:30. I think the whole entire group would love to see that, like where you not only we can like see the instructions, but we can see it visually, like as the prices are moving within the system. Because it's kind of my question was like close to Bimmy. I was like, I try to message with Tanya real fast. I'm like, that's close to my question. Let's go ahead and just see it visually in your simulator. But I'm sorry, I'm talking so fast, but I think it'll be cool if you can work that out on it's called Think Back or something like that.
Yeah, it's called On Demand.
On Demand? Okay.
Yeah, it's called On Demand. So I just pick an arbitrary date here, and let's see if we can run through some examples here. So today is September 22nd. That was Wednesday. That's a 0 DTE day.
Okay.
And we're looking at the chats here. We're looking at the ES here is running about 22 hot. All right. And I'm looking here to see where it's going to open. You know what? I'm going to switch over here to, first draw some lines. Price levels, 43. All right, so we're going to open up based on what the ES is doing over here. It's 23 up. So I'll be looking for something around maybe 25, maybe 20, somewhere down here, right? I'm just going to draw an arbitrary, maybe 20. Let's do 43.20. Oh, we just opened up. So you see that the price opened and it's moving up. Let me switch to the 15-minute. So I'm going to sell a put a credit spread because price opened upwards and it seems to be moving steadily up. ES seems to be increasing. So I'm going to go to the option chain here. Look for something around the 43.20. Let's see. $30, $20, $25, $20.15 maybe. Feels a little stressful, doesn't it?
Yes.
Okay, I'm just going to pick a number here, 55 cents. Let's go with 55 cents here because it seems to be increasing here. And I'm going to go for, let's go with 10. It's just for example. I think as it comes back, as it pulls back down a little bit, it should increase in value and possibly sell. So what is it trading at right now? 50, 65. Let's do it. Sell, sold. All right. So now I'm in the trade. Sold 10 of them for 65 cents. And I am currently up $150. my next job here is to monitor these and ensure that if we're trending up, we're doing well. If it starts trending downwards, I need to manage this trade. But first, what I'm going to do is I'm going to go back to monitor here, and I'm going to set my closing order here for 10 cents, right? I'm going to buy them back here for 10 cents. This is my buyback order. I haven't set a stop loss yet. So notice that when it hits somewhere around here between 43.70 and 44.10, then the value of my spread at that point will be around 10 cents. I don't know how long this is going to take, but I'm going to fast forward here a little bit to just show you just exactly what happens. If you go down to the 5-minute level, it's very stressful. So I like to stay at the 15-minute just for my own sanity, right? And I can monitor the value of my spread by going to the monitor screen and seeing what the value is. Notice now the mark is 55 cents. Remember, we sold it at 65, right? We sold it at 65, and we're waiting for this one to get to 10 cents before we can buy it back, right? It's now at 30. The margin requirement was 5,000. Why was it 5,000? It's because we had 10 spreads. Each of them required $500 to trade, and that's why we needed $5,000 in order to play this. And we received $500, I believe, in credit. So right now I'm pretty close to break even. It's fluctuating between 60 and 50. I'm losing a little bit. I'm not too worried yet because I've not hit my stop. I don't have a stop yet, by the way. So this is still a 5-minute candle, the first 15-minute candle. I'm going to fast forward here just so that we can see what happened on this day. This was Wednesday. Hopefully this is helping. So I'm just going to fast forward here about 15 minutes. Did it work? Fast forward 3x is what I meant to do. I'm constantly going back to the monitor screen. I'm now down about, fluctuating between -25 and 100. Remember that at any time you see profit, you can close it if you've met your goal. My goal today is, since I sold it for 65 cents, my goal is to buy it back at 10 cents and make, about 55 cents. So right now I'm down back and forth. I wonder whether I can, is my fast forward moving? It's not really moving, is it? I think I can go to on demand and actually force it here. Go. So if you're using the on-demand feature, look to the left, the top left, and as it is buffering the data, that is when it says it's pre-buffering. But once it stops, then it goes back to the on-demand. So we're still fluctuating back and forth. We've already finished a full. Have we finished? Yeah, full 15 minutes. We're now into the next 15 minutes. And maybe as that bakes, let's answer a few questions. That was Maisha's question. Mahia, what's your question?
Hi, can you hear me okay now?
Yep.
No, okay. So I have here that volatility, sorry if you've already mentioned this in this call, but volatility for credit spreads needs to be high. So am I looking at the asset volatility or am I looking at VIX volatility?
So a lot of people look at VIX to identify whether volatility is high. High VIX translates to high volatility, which also translates to higher premium prices. It also means that you can get better credit when the volatility is high. In the first 20 minutes of the trading day, that is when you're going to see one of the most highest or the highest volatility of the day. Two periods actually during the day that you get high volatility. First 20 to 30 minutes of the day, 9:30 to 10 o'clock Eastern, and then 3:30 to 4 o'clock Eastern. So the first 30 minutes, last 30 minutes, right?
Okay.
That is when you get, that's when the volatility is highest. And you want to sell your premium, you want to sell your spreads during one of those times. I prefer the morning. Some people do it in the afternoon. I don't recommend it because you have zero time to recover. I like in the morning because you've got all day to watch the play and recover if you need to. So,
And just to clarify, this is referring to like the overall VIX volatility and not the asset volatility itself.
that is correct. Even though the VIX translates to the asset volatility, remember the VIX is the overall market, right?
Right.
So right now the VIX, if you're looking at it, is at trading is about 22.93, right? And that's pretty high. Some people might consider it pretty high. And actually, I think it is high because when the VIX is much lower and the price is 43.70, you would not be able to get any premium at even 43.40, but we were able to get premium 43.20. So that's a good thing. The farthest away that you can get from the current price to sell a credit spread, the better, because you're improving your chances of expiring out of the money, which is the desired outcome.
Okay. Now, if I were to look at the asset volatility, just after looking at VIX, then what would I be comparing the asset volatility to decide if the asset volatility is also, high or low?
So are you referring to, where are you seeing the asset volatility? Are you talking to those numbers that I was looking at up here on the option chain?
So there is a volatility thing in TradeStation. I'm not sure where that would be in Thinkorswim, but every asset does seem to have a volatility at the top.
Okay.
In TradeStation. It says highest volatility. I'm not sure.
Okay, I think I would need to see it to relate to it. So
okay,
yeah,
it's fine. Thank you.
We'll look at it later. So
okay.
So we're still trading at about 47 cents. Or 67, I should say. And we're waiting for this to come back down to 10 cents. So we'll answer a few more questions and then we'll fast forward the time. Let's see.
New said, why did you use a strike price, or why did you pick 43.20?
Because I indicated that based on what the ES was telling me was that we were going to trend upwards, right? And so I wanted to buy opposite or sell opposite of where the market was going. We said that when the market is going up, you sell a PCS. When the market is going down, you sell a CCS. That is why I chose the bottom side or the opposite side of where the market was going. Additionally, I chose 43.20 because it was far enough away from the action. Now, in live trading, you may or may not get that particular play, but I'm replaying an actual play that I played on Wednesday. That's why I'm so confident about this one. So let me fast forward this to maybe 10, 15. See how it looks like. And it's pre-buffering now, which looks like we are continuing upwards. That's good. That's very, very nice. And if I go to the monitor screen, we're now down to 25 cents. If my spread value goes down to around 20, 25 cents, usually that's a good indication that it might even expire worthless. However, my trading plan does not say to let it expire worthless. My trading plan says to buy it back between 10 and 20 cents. So at this point, I am already up $450 or $400, give or take. And I could exit the position, but let's wait until, let's see whether we actually get to 10 cents on this particular trade. So I'm going back to the chat. Things are looking good. Let's see what Nicole has to say.
Hey, Eddie, thanks. So I just have a quick question. So on the chart, you have the, you've already put in your close order. We know that your buy to close is set for 10 cents. That background noise is not in my house, by the way. We can see on the chart that it looks like that 10 cents is probably sitting at about 44.05. Is there
you're competing with somebody else. I wonder who else has got
I can't tell who's unmuted.
It says Yanika. Okay. I don't hear it now.
I think it's Dwayne. Dwayne, do you mind muting?
Was it me?
Yep.
Okay, so on the chart, so you put in your buy to close order at 10 cents. We can see on the chart that that's approximately like about 44.05. My question is, if you had put in like your buy to close at, let's say 5 cents, is there a way before you actually put your buy to close in to see what, I guess, for lack of a better word, what price that equates to?
There probably is, but I'm not sure how. There is a way to actually set your closing order based on a price as opposed to based on the mark. Okay. However, since you're trading on the price here, the premium, it would behoove you to trade on that and remain on that, but you can set your stop loss based on the price of the underlying. I've seen some people do that actually. Never really paid attention to how they do it or why they do that, as opposed to making it. Let me see if I can do that. I can change it to based on the MAC, based on I don't know yet. I've seen it done, but that's not one of the things that I normally do. So I will have to pause on that one, maybe research that.
No problem.
Let you know.
I'll research
later.
it too.
Yeah.
Okay.
But but right now we're still at 25 cents, and we're barely moving actually. So that gives us time for one more question, another question. Hey, Lisbon.
Okay, next person. Lisbon. You had one question from Karen typed in, and she says, if you want to set your alert for when the premium gets to 30 cents, you would do that based on the option chart or the verticals?
You would have to map out the actual trade and then set an alert on it. There's actually a way to do it, but I don't set alerts on the premium for verticals. So
okay, great. Next question.
Yep.
Thanks, Eddie. This is Lisbon. So when you did the first trigger OCO, I noticed that there was a link field. Do you change that to TRG, or do you leave it as the man?
Usually it's fast triggers OCO. That's the one that I normally use.
Okay, and so when at the bottom where it says link, that stays as the manual? I'm not sure.
Let's take a look. So let's assume that I want to sell these again, and you're saying change that to fast triggers OCO.
Yes.
And then create an opposite order and create
Yes.
a duplicate order. And then I will change that. Let's assume that was $1 and that's my buyback. Which one do you
To the left, the field that's to the left.
This one would be stop. Okay.
Two to the, yes, right there. Do you leave that as manual?
Yes.
Okay.
Yeah, I don't change any of this.
Okay.
Yep.
Thank you.
All right. Yeah, all these times are Eastern. And if you're using the on-demand feature, by the way, I should say that this is Eastern time. So whether you're in California or Hawaii or Australia, make sure that this is Eastern time. Also, if you want to do 3 p.m., don't do 3 over there. 3 will mean 3 a.m. in the morning. If you want to do 3 p.m., you do 15. So it's military time. That's one of the quirks of this thing. But once you get the hang of it, you'll understand it. So always do the military time. So 3 o'clock would be 15. 4 o'clock would be 1600.
Great. So Eddie, you have 3 more questions. Is this going to be your last, or did you want to hang out?
I'm waiting for this trade to bake. I really want to bank that. So I have time.
Okay, cool. So Joe, are you ready?
Eddie, I just wanted to, it's a quick question. How long do you wait to get in? Did you say 9 o'clock, like 30 minutes before aftermarket opens?
No, if I have a pretty good thesis, then I will usually be in the trade in the first 15 minutes.
But you know, that volatility, like when it, sometimes it'll just there's a long red candle or a long green candle and then it reverses direction.
Yeah.
That happens all the time. So
yeah, that's usually a very stressful time, I have to admit, because you don't know whether it is going to retrace. So what I do know about the SPX is that when it opens in the morning, it will tend to gap up or down. If it gaps up, it has a tendency to want to fill that gap before it goes on to its merry way. That is the usual. But that's not the only thing that you should be watching for. In fact, you can use that to your advantage if you know that it gapped up and that it is going to retrace before it moves upward. That's a perfect opportunity to actually play a call credit spread here at this point. And as it goes down, the value of your call credit spread decreases. And once you see that turnaround, that's your point to exit. Because you know from that point on, your credit spread is now in danger. That's one strategy. It's not for the faint of heart. You have to know exactly what's happening and you have to see these enough times to know when that's going to happen. Right?
thank you. That's something.
So those kind of plays are the ones that last about 30 minutes and you're out. And at that point, don't even look for the 20 cents. If you can get your, 30, 35, 40 cents, whatever, do it and get out. Yep. So let's see where we are. We're still at 400. We're stuck on these. Let's fast forward these to, let's see, we're at 10 o'clock. Let's go 10:45. All right, 10:45. We're still heading upwards. Let's go to 11 o'clock. Does anybody like on demand?
We do.
Am I asking the obvious question? All right, so pre-buffering over here. I'm waiting for the data to tell me, because it seems like I might have hit my price. I'm waiting for this pre-buffering data to come in. There we go. Okay. Sold or bought. Did you all hear that? I'm out of the trade. I've locked in that profit. So if I go to my monitor screen here, I sold it at 65 cents and I bought it back at 10 cents. Right? So I've locked in my profit here at 55 cents. That's $550. This PL, negative PL that you see here is based on other trades that I've been testing. So this would say $550. Actually, let me see whether I can do PL for the day.
So you can do that buyback at the beginning of the trade if you want.
Oh yeah, yes. Yes, so you can do it at the same time that you enter the trade. So, yep, I just added the column here that says PL day, so that is $550 American locked in. So now that we've done that, just for the heck of it, let's roll forward to about 3:30 p.m. on this day.
Quick question. Can you make the screen a little larger? One person asked me.
This is that large enough? This is as big as it gets.
Okay.
Let me make this 1500. So 3 o'clock on the same day. I haven't. Just want to see what we're looking at. So 43.90. Waiting for the data here to come in. All right, we're done. And I want to see what the price here of 43.20, 43.15 is. So I'm going to go to 43.20, 43.15. It is now worth negative. Right? It's worth negative. So the question, it begs the question, could I have let these expire worthless? And the answer is yes. Is it worth my time to wait all day long for 10 cents? Nope. Got better things to do.
Right.
Yeah.
And Denise asked you, she said 10 cents seems high. Would you change once you see?
I go for 20 cents. I don't even wait for 10 cents. Yeah. So my strategy is make a bit of money. Well, how much is that? 50 cents, right? Or 40 cents times many contracts. And that's what my plan says. Once I am out, and it will normally take me about an hour or so, I don't have to worry about these anymore all day long, and I don't do it more than once a day, just once. So let's see, what other questions do we have before we sign out?
Dwayne. Hi, Dwayne. Thanks for
How you doing? How you doing, Eddie?
Hey.
How you doing? I just saw that the trade that you just did, I saw the buyback, but you didn't put a stop order on it.
Yep.
I noticed when I do those trades, a lot, I do the whole OCO order with the buyback and the stop at 1X. And a lot of times the option to get to jumping around with the SPX itself hasn't really moved. It haven't even gotten close to my short leg either way or whatever. So a lot of times I have to, because it hasn't moved, I have to cancel my stop order so I won't get stopped out. I judge it like that. Do you do it that way sometimes? Like the option to get to going close to my 1X without the SPX even moving up or down maybe 5 or 6 points. And just so I won't get stopped out, because I'll cancel the stop loss for a while, and I haven't lost any trades doing that, but it is really, really nerve-wracking.
Yeah, it is nerve-wracking. I do set my stops almost religiously, and I usually do that after I've entered the trade.
Okay, not at one time.
Many times I do it one time. If I'm relaxing and I've got a lot of time, the market is not really moving that much, or I'm still trying to find direction, I will set up my play and got my finger on the trigger when to hit send. A lot of times at 9:30 in the morning, I don't have the luxury of setting all that up. So what I do instead is I will sell it and then put the entries for the stop and for the take profit after that, usually within about 5 minutes.
Do you ever see? I know you do. You do this probably more than all of us. Do you see it where, like, just if you get a credit spread of 60, so 120 would be the stop, and you see it sometime where the SPX is not really even moving, and then it's going closer to your 1x stop loss, and that's what happens to me a lot. It's moving, going up to $1, 110, but the SPX is not even moving. It's not even close to my short leg, and just so I won't get stopped out, I cancel it. And then I know one day I'm gonna get burned really badly. I can see it, but I have to do that because I'll get stopped out if I didn't cancel it. I just only do that sometimes when the SPX is not really moving. I judge it like that. Do you ever do that, or you just, when you put your stop, you just let that in and just take the loss if it comes?
Yep. If I set the stop, it means that that's my pain point. I am comfortable losing at that much. And in fact, the days that I put a stop loss is when I'm very uncomfortable with the trade, right? Okay. And many times, even if I put a 1x stop loss, I will more than likely, if the trade is not going that way, I'll probably exit the trade before it even hits 1x.
Okay.
Yeah.
If it's just going the wrong way, you even do it, even take less of a loss than 1x. I was thinking about that.
Absolutely. So many times, actually my threshold is about a half x. Right.
And you judge it out the 15 minutes. If it's going in not in your direction, you look at the 15 minutes and it starts going against you, and you might stomp out at half X or something.
Many things, not just the 15. It depends on what the ES is doing. If it's breaking key levels, it's not respecting some of the levels that I set, then my thesis is completely wrong. And at that point, I know that it's going to be, challenged. So I just get out. There are days that 15 minutes into the trade, I see this is totally wrong, and I want to get out.
Yes,
right?
yes.
And I do get out. I don't wait until my 1x. So just because I have entered the trade doesn't mean that I have to go all the way 100% to where I am taking the stop loss or getting the profit. You have to gauge the market. You have to be in tune to see what's happening with the market. Visualize, not okay. I use this screen a lot. Okay. Apparently it's not available on demand, but yeah, I do look at other things. If there are other events that are happening during the day, for instance, the Fed is speaking. Now if the Fed is speaking, yes, usually I might not even be in the trade that day, because I ought to know that he is speaking, or something is going to be announced, or there's a report that is coming out maybe at 10 o'clock or 12 o'clock. On those days, I tend to wait until after that event.
Like this week, right? He spoke late in the afternoon, and right, I was in two verticals before he spoke, and I was profitable on both, but it was nerve-wracking. I wanted to jump out the window. It can get really bad sometimes.
Yes. Especially if he's talking in the afternoon. Now, they don't have Wi-Fi at my golf course, so that's out of the question.
Thanks for all your help, Eddie. Really appreciate your help.
So yeah, that's the deal. Yeah, if you're speaking there, if there's an event that could swing the markets, go do something else, man.
I should have taken that advice. I was very lucky that day. But thanks for your help, Eddie. Thanks again.
Hey, you're welcome, man. You're welcome. Mm-hmm. All right, let me see.
We have one last question, Monica.
Hi there. So I'm kind of just trying to figure out. I understand the concept of support and resistance.
Yeah.
But I'm trying to figure out how I see this one here on the screen now that's at 4320.
Mm-hmm.
That it's sort of, I could liken it to the proximal line at the buyer's level. But
no,
where would you sit?
No, 4320 is just where I sold the credit spread. So I wanted to make sure that I give you a visual of where we sold. It is okay. It is not. I'm not charting this to make as though this is my proximal line. My proximal. In fact, I'm on the 15-minute. I should probably show you the daily here. So I always tell people chart the SPX on the daily. That's very important, and then watch it on the 15 if you can.
But how are you determining where to place your support and resistance lines? Is what I'm trying to figure out.
Based on based on the charting. So I should have charted these and seen that this was my next buy zone or something like that.
Okay.
But I'm also determining that if I have premium that far out, then I will try and get it. But most times you don't have any premium that far out, right? So we're selling premium. The only time that you can get good premium is in the morning, in the first 30 minutes. If you're not in your spread by 10:30, 10:15, actually, 10:15, 10:30, just pass on that day. That's my policy. Pass on that day. So.
Okay, so because that's a buyer zone right there, where I'm seeing the line, you're just going to the very bottom of the formation for the support line. Would that be accurate?
I don't know. I haven't charted it. I think you're still thinking in terms of charting this. I did not chart this.
Yeah.
Yeah. There's don't let that. You might not be ready for this. Sunday class, they talk about the charting, and they go in deep.
No, I'm familiar with. I guess I'm just trying to figure out how you're figuring out the zones and where to find your strike price. That's where I'm a little bit lost. I understand the charting concept and I understand support and resistance. I'm just trying to marry the two, I guess.
Understood. So rewind this video about maybe 30 minutes or 40 minutes where we talked about the expected move of the underlying, right? So we decided that the expected move for this particular day, and I don't have it here anymore, was what's my expected move? I think it was around 28, something like that. Yes. It was about 28, 30, yes. Give or take. On demand, it's not there. That data is not available here, but on your live, it should be there. And that was the data that we were using to determine how far out we need to be when we're thinking about where to sell. So yeah, that's what was driving. The other way to think about it is in terms of what is the ATR for this particular underlying, and we saw that it was 50 points or 51, right? And so I needed to be 50 points away from the current price. And sell at that point if I can. And the reason I'm saying if I can is because many times you will find that you don't have premium 2 or 3 strikes away. This is too close to the fire. SPX can easily move that 20 points in a heartbeat, and then your spread would be in danger. That's why you need to be as far away as possible.
Okay.
Yep, as far away as possible. So just to recap what we've been talking about today, we've been talking about credit spreads. We discovered that your short leg is always going to be closer to the current price. You want to be as far away from the current price when you're selling. The best time to sell is when there's high volatility, usually in the morning, the first 20 to 30 minutes. Also, you want to buy back your spread. Right, so if you sell it for 90 cents, $1, then you want to buy it back for about 20 cents. Remember, we're selling high, buying back low. That is my strategy. The reason we do that is for peace of mind, right? It's not that we love the market so much that we want to leave money on the table, even though that's a noble idea, but I don't think you're going to be getting any prizes for that. It's for your own peace of mind, so that you can exit the trade, go do your thing, let the market play out. This market does tend to swing. It will swing. It's not an if. It will swing, especially the SPX. That's why we love it, and that's why we benefit from it. Once you've discovered how it works, then we play that game. So because we know that it's going to swing back and forth, up and down, we don't want to gamble, and we just want to get out as soon as possible. The other thing is position size is super important. Even if your account size has got many zeros before the decimal place, try and go for a small position size. In fact, you would rather play small many times than play big a few times, because max loss is real. Right? The max loss on this makes this trade ridiculous. We just saw that even with a 90 cents profit, your maximum loss is $410. That is, that's not worth it. That's bad. But your thesis should be that once you get that premium, you're buying it back. Never ever go for max loss, right? I can't say that enough times. Never go for max loss. You have enough time, plenty of time, to prevent max loss. My rule of thumb is if the value of the spread is greater than $2.50, that's just way too huge. There's no reason to give them an additional $250 per spread. So no matter what, my 1x, 3x is never ever going to be more than $2.50. That's just my rule. Your rules may be different. I usually go for a 1x rule, or sometimes even 1x or half x, and that's again because I have a high, or rather I have a low tolerance for pain, right? And that's the way you should be as a trader. You should have a low tolerance for pain. No need to lose a lot of money to know that you're wrong. Put that pride away, get rid of that ego, admit that you're wrong, move on to the next trade, right? If you feel that your stop loss is going to hurt you in a way that you cannot comfortably put on the next trade, then it is likely that your position size is too big, right? Maybe you need to do, if you are thinking of doing 10 spreads, 15 spreads, bad idea, right? If you look at the max loss, or if you look at your stop loss and it is too big, then that is just too much. If you're going to feel pain from that, reduce your position size to where you're comfortable, right? To where you're comfortable. Watch your trade. Like I said, get out as quickly as you can. Manage the trade with a 1x stop loss. Buy back your order. Sell the spread as far away from possible. Remember, today we're talking about both put credit spreads and call credit spreads. In a later topic or later video, we might actually talk about debit spreads and how those might be a little bit better. So let's see, Latonya, what kind of questions do we have? Any questions? It's now 3:50.
I see Joan hand is up, and I don't think we had too many more in the chat. So you want to take Joan?
Yes. Eddie, I just want to ask really quick. I know you do 0 DTE, but I see in our Facebook group, people are posting that they're making sometimes, making a few $1,000s off verticals. They're not doing 0 DTE. Do you ever buy for time on your verticals to make more? Because of course the premiums are going to be more the further out you go.
So the further out you go, the better the premium that you get. But those premiums also decay much, much slower. They also introduce risk because you have no idea where the market is going to be that far out. And I think you're talking about 7 DTE, 10 DTE. Short answer to your question, no, I don't do that. I only do 0 DTE. I don't even do 1 DTE, right? Not that it's bad. You can do it. Practice it in Sim, get a strategy on it, test it out, and then you can find your way there. For me, I have found comfort in 0 DTE, and that's why I stay.
Thank you, Eddie.
All right, good deal.
Okay, Eddie, you've taken all questions. It's 1 o'clock my time. I don't know.
Yep. All right. Good deal. I am loving it. So,
you know what, Eddie? I had a quick question if I can just throw out there, and it's not related to this. I wanted to save it to the end.
Sure.
And it was regarding the quadruple witching. I know that you don't believe in.
Yep.
But with the September, and this is the second September I've seen it, and I've seen it for other months too.
Yeah.
Where things are flying through your buy zones, they're flying through your charting, not holding up. Where the charting is not reliable during this time, this unstable season. The VIX flies up, so that's another indication that something is going on. Why do you think quadruple witching is a non-event?
It is an event of some sorts, but it is not worth my time to sweat over. And the reason is because it's well known, so far in advance, that it is going to happen about 4 times a year. What does that mean? We know that about 4 times a year, there are times when, well, actually, I don't know whether it's 4 times, but there are times when a lot of securities are expiring on the same day, right? On the same Friday. It just so happens that in September and in March and in, I guess, June or whatever, then, that is when we have that event, and it coincides with the seasonality of a lot of things going down. So that plus the fear, remember the VIX going up is an indication of fear. That is why the VIX rises, is what brings the prices down for some things. So many traders might do things on fear. I don't make decisions based on fear. I make decisions based on fact. Zero emotion to it. If price is down, it's in my buy zone, I am buying. If it's in the sell zone and I need to sell, I'm selling. Anything else that somebody says, I don't care. I don't buy it.
All right. I just find the charts are not reliable during that certain time. So, I could see something in my buy zone.
Yeah.
Which I did. And I bought, and then it went lower.
Yes, because we're in September as well.
Right.
Right. We're in September. So just remember that September is historically a low month for the stock market.
Okay.
Yeah. In fact, I think it's the lowest month for the whole year.
Yeah, I think you're right. And I know this. I know. So, but I just was looking at the charts like, okay.
Yep. Yeah, don't let the code reaching thing get you. It's just look at the charts. All right, good deals.
Great, thank you.
Deal.
Thank you for a great class.
All right, awesome, everyone. We will catch up. Not this week. Next week is my birthday coming up, and
happy birthday!
Thank you. Thank you. Thank you.
Party at your house.
Yep. So I'm going somewhere. I do not know where. I saw something run through my debit card on Delta Airlines. I have no clue. My wife is arranging that.
You just know you're going somewhere.
I'm going somewhere. Yeah, I'll probably get told where. So, all right, guys.
Great. All right, well, enjoy your birthday.
Thank you.
All right.
Thank you so much.
Good to be Eddie.
All right, guys.
All right, buddy.
Thank you, Eddie. Thank you, Latanya.
Thanks, Eddie. Appreciate you, brother.
Thank you, Eddie and Latanya.
Thank you.
Thank you, Latanya.
Thanks, Eddie.
Tanya. Thank you.
Thank you, everyone.